It's looking more and more like sustainable real growth, and that says a lot for the stock market.
Behind the scenes there, we're going to see probably a little bit more disruption in the reflation in the equity story.
Could we have several years of much higher inflation? Yes.
Danger is upon us, really, in a sense, and that behooves action, and I think the Fed did the minimum.
The Fed doesn't know either when this transitory notion is going to go away.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The great reflation trade turns into perhaps the great unwind from New York City. Good morning. This is Bloomberg Surveillance. We've got Tom Keene, Jonathan Ferro, and Lisa Abramowicz. No, we do not have Tom Keene or Jonathan Ferro. We do have Matt Miller and Riley, and Taylor Riggs.
Do you know
it is
my
that
name?
kind of morning.
We have Riley, too.
Yeah, we do all have
Riley as well.
I'm also Brad.
Matt, help us get back on the rails, as Tom would say. We're going down in flames. There's a question here about what the message is from the flattening yield curves, the decline that we're seeing in longer-term yields. Matt, there is a feeling here of disinflation. Is that the correct call?
Well, that's what we're hearing from all of the central bank officials, as well as, yesterday we heard from the Bundesbank, and they should be the most hawkish European central bankers. And even Jens Weidmann said he doesn't see any inflation midterm. Yes, there's a spike right now, but he sees it as transitory. So although we had, real concern voiced by bankers, by Peter Hooper, an economist at Deutsche Bank, also by economists like Andy Haldane, we haven't really heard it from continental central bankers or from the U.S.
The interesting thing, Taylor, and come on in here, because it's not just what we're seeing in the yield space. We're also seeing this in commodities. We're also seeing the
100%.
rotation within the equity indexes, with the NASDAQ getting a bid and reaching a record high yesterday. The mainstay names getting bid up once again. Is this because of the Fed's hawkish tilt, or did this start earlier, as we saw, and was stemming from some sort of fundamental data or signs that people were reading in the market and in the economy?
You're right. It was all yesterday, that rotation around the closing bell back into growth, out of value. How much of that, of course, was value had a good run up, and so we were sort of unwinding some of that trade. And how much of it, I think, really has been the discussion of, wait a minute, we thought that we were going to be able to tolerate inflation. All the commentary I read yesterday, Lisa, was 2.25%, 2.5% max. And so what does that mean on further curve steepening? And of course, we know some of the fundamentals. When yields come down, that lower discount rate boosts the present value of those valuations. That helps tech, that helps growth across the board.
Yeah.
How much also, though, is it that if we're not tolerating inflation, you have a flatter, steep curve? And is that a surprise? I think everyone thought that there would be sort of an upside risk to yields. And indeed, the last 2 days has shown us there is not an upside risk to yields at all.
Yeah, this has been the huge debate. There's also a huge debate here about what the potential implication is right now of a Federal Reserve that does seem more split than it has in the past. It does seem as though members are kind of bifurcated as to whether to take a more hawkish tone or to let the economy
bifurcated has been called.
Very hot.
Do you guys drink? Every time we say transitory, we drink. Every time you do
correct.
Bifurcation, do we drink?
We can drink it every word
every
we
time
say,
someone says
depending on how things
bifurcated,
go.
I think that, I think that's my key word.
Let's look at it.
It's a big man as cranny favorite.
Let's move toward what we're seeing in markets today. NASDAQ still getting a bid up. And Matt, help me out here. There's an idea that perhaps big tech can continue to get a bid as growth reigns supreme once again.
Yeah, well, who knows if that's the case? We're not seeing any action in terms of equities. Here a little bit to the downside. There we see S&P futures not moving at all. It's really all about the commodities. I would be looking at lean hogs right now. They were dropping in the London trade, moving a few standard deviations away from what they normally do. Also, I'd be looking at the pound, really, as opposed to the euro, because that's some real weakness. You see pound weakness against the euro, pound weakness against the Swissy, pound weakness against the dollar. And I think that's pretty interesting to see as the UK continues to have problems with the virus and Northern Ireland. The 10-year yield there obviously is interesting, but it hasn't Well, I guess it's been up and down, but right now at 149, a little change, and then crude as well.
Unbelievable as we migrate out to further out in duration. Lisa with a 30-year now at a 207. Unbelievable. The moves we've seen, a drop of 16 basis points at one day yesterday. We could do bonds all day long, but instead, let's do a morning brief. Lisa, take it away.
Thanks, Taylor. I will say the move in the yield curves has been shocking. The idea here that the gap between 5 and 30-year yields now the lowest of the year. Today, it's triple witching. This is the every third month, every third Friday, we get the expiration of options and futures on indexes and equities, and this increases volume dramatically. What the potential implications are, it is unclear whether it's to the up or to the down, but you could see some pretty big moves heading into the close. 1 p.m. Baker Hughes U.S. rig count. This has been very interesting. Discipline has been the word of the year when it comes to the shale patch in the United States. They have not increased their production, even though prices have increased substantially. And the question is, will this continue, or will you start to see some of these companies bring production back online? And today, most government workers are celebrating Juneteenth. President Biden signed this into law yesterday. And Matt, I find this fascinating, this idea, the celebration of the end of slavery in America. The idea here is people are given the day off, and you're seeing that in certain banks, and yet markets are not closed. It takes time to decide to close markets. So banks kind of have a conundrum
neither
right
are
now.
we.
Right. Well, banks kind of have a conundrum right now, whether they allow employees to take off, how they remain there functioning, and then what to do for next year when they actually have a little more time to prep. Matt?
Yeah, I mean, most people are going to work today. City governments, state governments, those workers are also at work. Banks, exchanges, media.
Yep.
Obviously, we're all here. But I agree. I think next year is probably going to be a very different picture. Let's get back to markets. David Sauer, anchor and managing director and portfolio manager, standing by to help us kick it off. David, great to have you with us. Let's start with what's going on in yields. You know, you heard Taylor and Lisa just talking about that. We're seeing this incredible flattening, and we're not seeing any big moves to the upside that maybe you would expect as the world starts to turn hawkish. You know, of the 81 central banks, or maybe 83 that have made moves this year, most of them have been to the upside. And of course, with Powell's statement that we're talking about tapering now, and with the move in the dot plots, you'd think we'd see moves to the upside here as well. What gives?
I would think so as well. As a stock portfolio manager, I'm always very cognizant of taking special cues from the bond market, because the bond market is quite wise and very forward-looking. Nevertheless, I think bond yields are lower simply because you have so many corporate pensions that are trying to immunize their liabilities by buying long maturity, long duration fixed income assets. Foreign buyers still recognizing that while our yields are not quite appealing, they're still better than what you're seeing overseas. Nevertheless, I think the directional move in yields will be higher, because I'm one of those portfolio managers who believes that we're more likely to see incrementally higher inflation rather than drink my coffee, transitory inflation.
David, drink your coffee. We drink other things. There's a question, though, of whether this is just a pause and what the trigger will be for yields to go significantly higher.
I think it will be recognition that that this inflation environment probably won't stay at 4%, but the incremental move will be from a underlying 2% inflation rate to 2.5%, perhaps a bit higher. And once the market begins to recognize that, simply because if I look at 50 years of money supply growth, M2 money supply growth, we have grown about double the previous peaks. Usually the peaks would be 10 to 12% money supply growth. Now it's been in excess of 25% year on year. That is unprecedented. I don't know how that ultimately doesn't translate into incrementally higher inflation, but the inflation rates I'm talking about are more in the 3% range.
David, then square with me. What is a 149 on the 10-year, a 207 on the 30-year telling you? Are we fairly valued?
It's telling me that at this point in time, again, take my wisdom from the bond market disagrees with me because the demand is there. And I think as a portfolio manager, when I think about tying inflation rates to bond yields, then to stock valuations. The biggest risk for me as a portfolio manager is that I underestimate how much inflation is going up rather than to be in the transitory camp, because higher inflation will lead to ultimately stocks are still your best, I think, inflationary hedge or growth on a real inflation adjusted basis. But the biggest risk to me as a portfolio manager is I underestimate that inflation incrementally moves higher.
What's your sense of commodities, the fact that we've seen a pretty big move in some of the commodities, the metals, the agricultural products that got bid up the most heading into the peak reflation trade? Do you view this as a sign or perhaps an opportunity to pick up some of the commodities?
Lisa, I think I'm not a great technician, but I think on a technical basis, they were overbought. Look at how much lumber had gone up, coffee, corn, sugar, you name it. And it was overbought from I think a technical perspective. It's retraced its levels, but if you look over the last year to year and a half, it has been significantly higher. And I think that was simply a sign of demand and that the economy was improving. And I think commodities for a piece of your portfolio as a piece of a substitute for bonds makes good sense for total portfolio construction.
David Sauer, thank you so much for taking the time. Ankara, Managing Director and Portfolio Manager. This is a joy. The past week, we had our own Eric Schatzker down in Venezuela, and we now have a Bloomberg exclusive with Venezuela's President, Nicolas Maduro, speaking with Mr. Schatzker in Caracas. The focus is on normalizing relations with the U.S., but this does fit into the broader theme that we've been talking about all week of the great American reset of international relations as President Biden took a tour of Europe. The idea here is that Maduro would like to see relationships normalize with the United States, some of the harsh sanctions lifted. Take a listen to what Maduro had to say.
Siempre hay que recordar, Eric.
We always have to remember, Eric, that we faced 4 years of the Trump administration, which were 4 years of direct aggression, of cruel sanctions, very cruel, and of damage to the Venezuelan economy and society. The politics that Donald Trump installed and left as legacy against Venezuela are extremist politics, irrational, right? That caused a complete rupture between the United States and Venezuela.
President Joe Biden ha llegado.
President Joe Biden has arrived, making a proposal to the world. His first speech on January 20th, he said that we don't have to demonize anybody in politics. I would say to President Joe Biden to stop from the White House, from the Department of State, the demonization of Venezuela, the demonization of the Bolivarian Revolution, the demonization of President Nicolas Maduro, and that hopefully we can find paths of reconciliation, of respect, paths of mutual benefit, and paths that allow us to normalize relations between the United States and Venezuela.
¿Ha visto señales ya?
Have you seen any signals that suggest Joe Biden has a different posture, especially as it concerns the Venezuela question?
¿Quieres que te sea sincero, muy sincero?
Do you want me to be sincere?
Ninguna.
Very sincere? There hasn't been a single positive sign. None. It's 5 months where, okay, they're settling into power. The only different thing that might be heard from some spokespeople of the White House and of the Department of State is that they agree with the political dialogue between Venezuelans, without intervention, to look for democratic political changes in the country. That's the only thing. They must abandon the demonization that they make of Venezuela, of our revolution, democratic, constitutional, pacific, and of President Nicolas Maduro, to create real foundations, objective, credible, verifiable, of a process of negotiation to regularize the relations between the two countries, in terms of win-win, which is what we aspire to since a long time ago.
A win-win is possible, in your opinion?
Totalmente.
Absolutely. We've already shown that. Of course it's possible to win-win. They know it in the financial sector, the bondholders, with whom we had an impeccable relationship, and they know it's possible to invest in Venezuela and win-win, as long as this whole persecution and the sanctions aren't there. The oil sector knows it, who has invested in Venezuela, and who still maintains investments in Venezuela, that we can advance much more. The cultural sector knows it, the social sector, the political sectors know it.
Bloomberg's Eric Schatzker just returning from Caracas. He is here with us. I did not know that you could speak Spanish, Eric. Congratulations on the interview. I am curious, before we get into the substance, of what it was like in Caracas, given the COVID pandemic and how hard that region has been hit, and given the exodus of residents as a result of some of the financial crisis issues that this nation has been facing.
Lisa, it shouldn't surprise anybody that Caracas and Venezuela as a country are a shadow of their former selves. Don't forget, Venezuela was South America's richest country. At one point in the 1990s, it used to produce 3.5 million barrels a day of oil. Last year, that was down to 410,000, the lowest in about a century. And of course, that's visible on the streets of Caracas. The country doesn't have any money. First of all, you could argue persuasively that it was mismanaged by the socialist nationalist government of Hugo Chavez and subsequently Nicolás Maduro. But there's also these U.S. sanctions in force. They don't allow Venezuela to sell any oil. They don't allow Venezuela access to debt capital markets. The country has no money. It's in default. It's bankrupt. The infrastructure is crumbling. All of this is visible to the naked eye. But I will point out that there is, call them green shoots. Venezuela has relaxed some of its economic restrictions, and it is fascinating, candidly fascinating. I don't want to downplay the poverty, which is extreme, but to see these flickers of entrepreneurialism in a country that has been forced to loosen these strictures to try and find some way out of its desperate economic situation.
What, Eric, is the path forward? What is a realistic, in your conversations with him, a path forward to a loosening of sanctions, getting that oil back for the country?
Let's not forget that the Trump administration was pursuing a policy of regime change. It was trying to drive Maduro out of office. And as far as the U.S. government was concerned, there were good reasons to do that. Drug trafficking, rigged elections, corruption, all kinds of accusations and allegations for which there's much evidence against the Maduro regime. The Biden administration has taken a different approach. Tony Blinken, the Secretary of State, has talked about free and fair elections. That's the path forward. That's what the negotiations are moving toward. The United States, what remains to be seen, clearly Maduro is extending something of an olive branch. He wants a deal. He wants talks. He wants the United States to sponsor, along with the Norwegians, some kind of a dialogue with the opposition that moves the country forward such that these free and fair elections take place. People can, I guess, confidence can return to Venezuela, and ultimately the government feels as though the situation is stable enough and fair enough that it is willing to relieve at least some of these sanctions. And if that happens, I'm not in the business of making predictions, but if Venezuela is allowed to start selling oil again on international markets, and if investors are allowed to bring money to the country and pump it into sectors like petrochemicals, it might be quite amazing the kind of growth we would see in the Venezuelan economy, because it has, over the past 8 years, shrunk by, it's hard to believe, 80%.
Wow. It's been shocking. Eric Schatzker, thank you so much for going down there and doing this and joining us today on the heels of your trip. Right now, I really want to just get a reset of where we are in markets, because the moves, particularly in the debt markets, have been dramatic. And Taylor, you were talking about this, and you are correct. It is
thank you, Lisa.
Significant to see how much people are piling back into longer duration, people piling back into the dollar. It was the longest streak of gains in a long time for the dollar. This question here, since March 26th, I believe, of 2020, there's a question of whether this is just a reset or whether this is the beginning of a new trend that's disinflationary, Taylor.
And, you know, just sort of the confusion, I think, from all the notes that we've been reading, Lisa, of I think analysts and investors thought that the Fed should pivot, but they always thought that the Fed's really dovish and they might not. And then when they did actually talk about tapering, the market was a little caught off guard of, oh, we didn't actually believe that the Fed would do it. That's sort of the tone I'm getting from these analysts, Lisa, of like, oh, wow, I think it actually might happen.
And Matt, one thing that I'm struck by is that people are talking about the Fed tapering, and yet we saw the Fed's balance sheet rise to a new record high yesterday in the weekly report, $8 trillion.
Yeah, absolutely. I mean, they continue to spend, and so do the Europeans. I'm starting to wonder when we're going to see a race almost, or a game of chicken. Who's going to go first? Because these central banks are really starting to focus on their currencies, Lisa.
Yeah, indeed. Coming up at 7 a.m., Wei Li of BlackRock Investment Institute, Global Chief Investment Strategist, will be joining us. Maybe we'll have some better insight into the bond moves. From New York, this is Bloomberg.
Now, with the First Word News, I'm Leanne Gerrans. Firstly, more options for U.S. tourists. The European Union has lifted travel restrictions for American residents, adding the U.S. to its so-called white list of countries from which non-essential travel is allowed. The new rules mean EU countries are able to allow quarantine-free travel from the U.S. independently of vaccination status. Also added to the white list were Hong Kong, Lebanon, Serbia and Taiwan. Now, Germany has reached a milestone in its effort to beat the coronavirus pandemic. Today, the country's health minister said that more than half of the population has been partially vaccinated. About 30% are fully immunized. Officials are stepping up vaccinations as new virus strains are hampering efforts to contain the disease. Now, Boeing's biggest 737 MAX model is set to return to the skies. Bloomberg has learned the initial flight of the MAX 10 could happen as soon as today. That would mark another milestone in the jet family's comeback. U.S. regulators have cleared the jets to re-enter the market in November. The jetliner is not expected to enter commercial service until 2023. And North Korean leader Kim Jong-un says he's ready for both dialogue and confrontation with the U.S. This comes as President Biden's new nuclear envoy heads to the region to build support for a strategy towards Pyongyang. It is the first high-level suggestion of talks since Biden did replace Donald Trump, who did meet Kim Jong-un 3 times. Chinese officials are drawing up plans to further loosen birth restrictions and transition towards policies to encourage childbirth. Dow Jones is reporting that policymakers are discussing fully doing away with birth restrictions by 2025. This reflects the increased urgency in Beijing as economic growth slows and China's population does grow older. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
I don't believe that we're at risk of hyperinflation. We've had several months of high inflation that most economists, including me, believe will be transitory.
U.S. Treasury Secretary Janet Yellen speaking day 2 on Capitol Hill in front of a House Financial Services Committee. The key question is one of faith increasingly, Matt. I'm struck by this idea that the inflation debate really hinges on what you believe to be the case given the money that's been pumped into the financial system, but everybody looking past the current data and saying it is not something that can be relied upon because it could be very well transitory. I'm wondering, though, Matt, what the key data will be. I mean, we got initial jobless claims this past week. They were disappointing. They rose for the first time in months. The idea here is suddenly we're seeing unexpected weakness in certain labor market statistics, and yet people are shrugging it off. When does the data matter?
Right. Well, I mean, initial jobless claims, though, are famously volatile, right? And we're not even expected to reach pre-pandemic levels for another month. By the way, this reminds me of something else. Jay Powell and this current Fed relies on outcome-based frameworks, but he was talking a lot in his press conference on his expectations, his forecasts, his projections for the job market. This is something that Brian Chapata at Bloomberg Opinion has been talking about as well. But to get back to the data, I think the data is going to matter when you see it for a longer period of time. And we did see big jumps in inflation, CPI and PPI, but it hasn't stuck. And now that commodities have rolled over, the question is, are we going to keep seeing these high prints?
You know, Matt, you're not the only one that's picked up on this, and Brian Chapata picked up on this, but also over at JP Morgan, Bob Michael, he actually gave a question to Michael McKee and said, how is it that they say they're not going to be looking at forecasts, they're going to be looking at the data, and then they're hinging pretty much everything on their forecasts and saying it's transitory. Taylor, it does set up this conundrum in addition to the split on the Federal Reserve, where clearly members are not in agreement with one another right now.
And you're seeing that split in the dots, if we're even allowed to mention the dots, Lisa, for 2022, 2023 rate hikes. And I think the split with economists as well of, you know, we thought that there would be a run up in inflation. We thought that that would be tolerated. And at least on Wednesday, we learned that, well, it might not be so tolerated after all. We just heard David Sauer maybe 2.5% might be the top.
Yeah, and this has been the big debate that does continue right now, though we are seeing the yield curves continue to flatten, and we are seeing a rotation back into big tech. NASDAQ seeing its biggest close, its highest close ever yesterday, and poised for further gains, even as S&P is marginally lower. Another bid into 10-year yields. You can see if you take a look at 30-year yields, that's where you get even the bigger bid. Coming up, Jay Bryson of Wells Fargo. This is Bloomberg. Good morning. This is Bloomberg Surveillance. Taylor Riggs, Matt Miller, Lisa Abramowicz, John Ferro, and Tom Keene are off today. A well-deserved sabbatical, as Tom Keene would say.
I thought it was Riley and Brad today.
It's Riley, it's Brad, it's a lot of people that make this happen, this incredible orchestration of perfection.
Don't forget Justin Lau, please.
Thank you. Thank you. Anything else? Any other mentions? We're doing the Oscars. There is a question here about the great reflation trade and whether we're seeing the end of the hopes for perhaps a new paradigm. And Tom would make fun of me for saying paradigm, but we're seeing that in the data. And Matt, you know, I gotta say, there is a question of if this is true and if this signal is saying something, why aren't risk assets selling off more? Because frankly, a slower growth environment will not be good for risk.
Yeah, absolutely. But I think the Fed is probably the main reason for that. And not just the Fed, but also the ECB and other central banks have proven that they are going to continue to stick with this recovery and be supportive and be stimulative. You know, my question really is more around the rates. And what I'm starting to think is maybe bonds are the smart money and they're like 50 basis points by the end of 2023. That's nothing.
Yeah.
Who cares?
Yeah, no,
and they keep buying.
That's a great point. Right now, what we're seeing in the data is the NASDAQ continues to turn higher, poised for yet another high, up just about 23 right here. And we can see the S&P down slightly, although really basically unchanged, just down 0.1%. The euro gaining versus the dollar. This is a reset after 5 straight days of dollar strengthening versus its peers. And the idea here is we saw the longest streak of gains of strengthening going back to the peak of the pandemic in 2020. The great reflation turns into the great unwind. Jay Bryson, Wells Fargo chief economist, has been tracking the data. Unclear what the data actually says. Jay Bryson, based on the data, do we have any indication that, yes, this economic recovery is starting to stall out or give hints of having already reached its peak and poised for only disappointment going forward?
Well, I don't know, Lisa, if I would say disappointment going forward. I mean, are we at peak growth right now? Yes, probably. You know, in the second quarter, you're looking at a growth rate that's probably going to be 10% annualized. That's clearly not sustainable, right? And if you slow down in the second half of the year to what we think will be 6, 7, maybe 8%, let's face it, that still is a very, very strong growth rate. So again, peak growth right now, but you can't expect to stay at 10%.
All right, well, there's a question here about whether we can infer anything from the labor market data that we've been getting, the idea that we got a disappointment in the initial jobless claims. We've gotten disappointments on the monthly jobs reports that we've gotten out of the federal government. Are we gleaning anything from that, or is it still too early to do anything with that information?
You know, Lisa, I think it still is a little bit too early to really make hard decisions about what's coming out of the labor market right now. I mean, it's still being affected by concerns about COVID. If you look at surveys, when people say, why aren't you working right now? Concerns about going back to the workplace are up there. You know, there's still these extended unemployment benefits, at least in some states, that may be keeping some people on the sidelines. So I think we really need to give it, unfortunately, you know, another few months to see when the smoke clears, to see how we're doing in the fall as people are actually coming back to the labor market at that point. So at this point, there's still, I think, a lot of noise, a lot of things going on in the labor market that are keeping it a little bit maybe depressed.
Are you at all concerned about a price wage spiral, Jay? I know it's something that economists fear normally, but as Lisa said, we've gone through a real paradigm shift.
So Matt used the word spiral. No, I'm not really concerned about spiral. That's like, so, you know, when I think of wage price spirals, I think what we saw back in the 1970s. And back then, what you had was a fair amount of people had wages that were indexed to inflation. So you had the OPEC shocks that pushed up prices, then that fed into wages, automatically fed back into prices again and spiraled up. You don't have that same sort of thing today in terms of that. I mean, I think what would be interesting, or what we're keeping a close eye on, is inflation expectations. If they really start to become unmoored here, people really do start to expect higher and higher inflation going forward, then that does become a little bit of concern. And I think the data is mixed there. When you look at market indicators of inflation expectations, since the Fed meeting, they've come down significantly. The personal expectations, like what you capture in the University of Michigan, we'll see how that all plays out. But for me, that's the big key, is what happens to inflation expectations.
You know, Jay, from in your career from Johns Hopkins to Georgetown to the University of Alabama, you've been the entire time inside this kind of Reaganomics bubble, right? We've had this supply side economics narrative for the last 40 years, and that seems to have changed with this pandemic and with this, well, I guess the last administration was a big spender as well. But all of a sudden, modern monetary theory seems to have won the day. How difficult does that make your job?
Well, you know, you guys have been using the word paradigm shift, you know, and so it's clearly is that. Where are we right now in terms of what's the closest analog that you could look at? I think it would be the late 1960s, guns and butter. And we did get some inflation out of that. Now, it was really the OPEC shocks of the 70s that really got inflation starting to head higher. So that's kind of where we are right now. And what I would say, though, is it's a political decision going forward. You know, are we going to get all this infrastructure spending? Are we going to get this American Families Plan passed or not? That still remains to be seen. You know, we still have a very, very split Congress. And even among the 50 senators, Democratic senators, there's not unanimity there either. So it does make our job, the politics right now, I think, is complicates what we're trying to figure out going forward.
How are you thinking within this big paradigm shift that we talk about? The models that we traditionally look at, a Phillips curve, let's say it, the way that we're measuring inflation, the basket of which we're measuring, are those tools still intact?
Well, in terms of the Phillips curve, I think that was put to rest pretty much during the last expansion. Mm-hmm. You know, we got down to an unemployment rate that was at 3.5%. Traditional Phillips curves would have told you would have had a lot more wage inflation than we did. So that's kind of out the window right now. So yes, we are in kind of uncharted territory right now, not only with what's going on with the pandemic, but as well as the way the economy is responding to that. So when we think about the future, when we're looking at our forecast, and there's always a confidence interval around that. Unfortunately, that confidence interval right now is wider than what it always historically has been.
What about the level of divergence? I'm thinking on a global basis, a lot of the guests yesterday were hinting that the Fed has now diverged from other global central banks and thinking about where we are, how further ahead we are. Are you seeing a divergence of the U.S. versus other central banks?
Clearly, up until, say, Wednesday, there was a divergence. It seemed like other major central banks were leaning a little bit more towards starting to remove some policy accommodation. The Fed wasn't there yet. Now, I think what they hinted with the dot plot on Wednesday was maybe we're getting a little bit closer to that than what we thought. So I would say the Fed at this point is still lagging a little bit behind some of its international counterparts. But clearly there's been a reaction function shift at the Fed. It seems like they have what they've elevated is a maximum employment at the expense of inflation. But now that it may be starting to change a little bit as well. So the Fed is starting to catch up to some of those major central banks.
We're speaking with Jay Bryson, Wells Fargo chief economist. And Jay, every day on Thursday at 4:30 p.m., I take a look at the Fed balance sheet. It's when they release the latest outstandings. And yesterday, the balance sheet increased by the most going back 3 months. And it rose to the highest level ever of more than $8 trillion, crossing that line for the first time. They are talking about tapering, perhaps. And people are talking about tapering, but they are doing anything but. I mean, honestly, how much support is this giving to the economy at this point? And how much support is this given to bond yields, with people getting increasingly sanguine that they will stay as low as they are?
So, right. I mean, the Fed is taking down roughly half of the Treasury supply right now. I don't have a point estimate for how much that's worth on the 10-year yield, but it's clearly bringing that yield down. If the Fed tomorrow says we're going to start to taper, what do you think happens to the 10-year yield? It's going to snap higher. And I think they're concerned about that. They look back at the taper tantrum back in 2013 when the yield on the 10-year snapped up 100 to 150 basis points over a number of weeks. And I don't think they want to go back to that yet. And so we do expect that later this summer, maybe early fall, the Fed will start to hint about tapering. And when they start to really do that, you will see yields start to move up. But I wouldn't expect them to start to really dial back their pace of purchases until late this year and probably more likely early next year.
Jay Bryson, Wells Fargo chief economist, thank you so much. I got to say, it is fabulous having the close as the open and before the open on a daily basis. Taylor Riggs, as we head into the close and as we head into the open, since you're going to be working a 15-hour day today, there is a question.
How many hours is that from now?
Yeah, I mean, honestly, you can do the math, or maybe you can after not getting any sleep. But there is a question of the change in tone as we head toward the close and what we have seen day in, day out. The idea that we saw the melt up kind of changed tone. Can you just give us a sense of whether there has been that shift?
I think we saw a shift yesterday, sort of that rotation back to growth out of value. I bring you a note from Sebastian Galli, Lisa, over at Nordea Investments, and saying how much of this is that rotation after continued underperformance that we had seen of growth and shifting back into that. How much, of course, is, momentum and how this stock market right now, he says, appears to be pretty backward looking, not something we typically hear on a market that we try to assume is pretty forward looking. We'll have to see with the commodity shakeout if indeed it is a momentum back into growth.
Yeah, but
and yes, at the closing bell.
But how do you even look into the future if it's this cloudy? And that's, I think, a conundrum a lot of people are dealing with. Matt Miller, our correspondent from Berlin. There's also a question of the UK data that you talked about coming in disappointing.
Yeah. The retail data was disappointing, and Tesco shoppers are going out to eat instead of going back to the store. So you got to watch out, especially with the virus there.
Yeah, although we all want to go out to eat. Coming up, Andrew Pekaj, Johns Hopkins Bloomberg School of Public Health professor and virologist, weighing in on the latest with the pandemic. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. More options for US tourists. The European Union has lifted travel restrictions for American residents, adding the US to its so-called whitelist of countries from which non-essential travel is allowed. The new rules mean EU countries are able to allow quarantine-free travel from the US independently of vaccination status. Also added to the whitelist were Hong Kong, Lebanon, Serbia and Taiwan. Now, Singapore is scaling back its reopening plans amid dozens of new COVID-19 cases over the last week. The government says on Monday, higher risk activities such as indoor dining at restaurants and going to the gym can resume in groups of just 2 people instead of 5. Officials say vaccination rates are not high enough to justify wider easing of lockdown rules. And for all that talk of a commodities boom, some markets have now wiped out gains for the year and several more are close to doing so. Soybean futures have erased all their 2021 advance, sliding more than 20% from an 8-year high reached in May. Corn and wheat have also tumbled. On Thursday, the Bloomberg grain spot sub-index slid the most since 2009. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Today, the Biden administration announced their investment of $3.2 billion from the American Rescue Plan as part of the COVID-19 antiviral development strategy. It's a whole of government effort aimed at developing the next generation of COVID-19 treatments, as well as preparing us for future threats.
Dr. Anthony Fauci, NIAID Director, National Health Institute leader there, talking about what to expect in the path forward. Meanwhile, today, the European Union opened travel restrictions for U.S. residents, marking the reopening, perhaps, of the transatlantic corridor, perhaps the first step to getting there. The question is it too soon? And Andrew Pekosh, with all of his COVID stuffed animals behind him, who joins us on a regular basis, we are so lucky to have with us now Andrew Pekosh.
I hope they've been vaccinated.
Johns Hopkins, a Bloomberg School of Public Health professor and virologist. There is a question as we reopen borders here, as we have this sense that it's over, that we could potentially be setting ourselves up for failure, for variations, for some sort of escalation in a third or fourth wave. How realistic is that?
Well, the positives are that the numbers across the U.S. are looking really good. Obviously, infections are going down. The infection rate, meaning the testing of samples, is going down. So everything looks good with respect to the pandemic at this point in time being controlled here in the U.S. We have to understand that that's probably a combination of 2 things. The weather, people working outside more, transmission conditions aren't as optimal for the virus right now, and the vaccination campaign has really worked well, in particular to protect the very vulnerable in the population. So everything looks good right now for opening up economies, for allowing people to travel. The general public should take advantage of this and really sort of re-embrace what life can be like without the virus around. But we've got to think a little bit further down the line, and my lab, other people are thinking about the fall. What happens when people get back inside again, when conditions are better for the virus to spread? Will we see a resurgence? And in particular, will we see that resurgence in the people that aren't vaccinated? So 3 months down the line is what we're worried about. Right now, I think from a positive perspective, people should really get out and try to enjoy themselves while continuing to realize that the pandemic is not over. We're just at a good place right now in terms of controlling the infections.
You talk a lot about the vaccines. I am curious, where are we on that vaccination campaign? There'd been a big uptick, of course, in rates, vaccination rates. Then it's sort of leveling off. Where are we now in terms of the campaign on a rate higher of vaccinations?
We're creeping forward. I'm still optimistic that we'll hit that 70% vaccination rate that the president has set for July 4th. But given all of the positive results that are coming from the vaccination campaign, not only the fact that the safety signatures are really coming through incredibly strong, but also the efficacy of the vaccine, and in particular the efficacy against variant viruses, maintains a very high level. So this vaccine looks really, really good. It continues to look good with all of the studies that have been done since it's rolled out. So it's a little bit of a head scratcher as to why there isn't a more broader acceptance of this vaccine, because there really isn't anything about it that would cause that should cause any hesitancy for people.
I wonder about the Delta variant and how much of a concern that is, because the Brits are pretty well vaccinated as well, and they're seeing what looks like another wave of infections.
Yeah, the critical thing about that is it looks like fully vaccinated people. So if you're talking about the mRNA vaccine, people who've gotten the second dose and are 2 or 3 weeks out from the second dose, those individuals seem to have a good response that protects against the Delta variant. Remember, the UK took a different strategy. They tried to immunize everybody with a single dose initially to get broader immunity. And the Delta variant is showing us that that broader immunity is not necessarily enough to protect against it. You need the double dose immunity, the stronger immunity from a full vaccination course to really protect against that virus. So if you stick to the 2-course vaccine that we're doing here in the US, we should be able to provide really good protection against the Delta variant.
Andy, what's the latest on boosters, whether we need them?
So far, everything looks good. You may see some piles of plates behind me here. We're looking at people who've been vaccinated 6 months ago, trying to measure their antibody responses and how they're declining over time. All the studies so far look good, and because this fully vaccinated regimen provides protection against variants, I don't think there's a big emphasis yet on trying to push a booster through. What would drive that is if we see a really new variant that is evading that full vaccination immune response, or if we really notice that 12, 14 months after vaccination, you see a really significant waning of your immune response. But neither of those things have really come to the light yet.
Should we be at all worried about other virus outbreaks, Doc, or have we prepared ourselves through this pandemic for anything that may come our way?
No, I mean, pre-COVID-19, we did all of our work on influenza, and that's coming back to the forefront for us this year. The social distancing efforts that were put in place to limit COVID worked incredibly well against influenza, but we fully expect that those things won't be in place in the fall, and that we'll see a resurgence of influenza coming. We've already seen a resurgence of RSV, respiratory syncytial virus, which is a very serious infection, particularly in very young children. That started to come back already. So we are worried that, these loosening of restrictions will bring back some of the viruses that we haven't seen in a while. And we don't know what that means in terms of the case numbers that we'll see from those infections. So we're now preparing for flu just as strong as we're preparing for COVID-19 this fall.
Dr. Pekosh of Johns Hopkins Bloomberg School of Public Health, thank you so much for being with us. Phuket just reopened to tourism. So, Taylor, if you are looking for a place to go after your sojourn on a motorcycle, as you posted on Twitter, perhaps Phuket.
I think.
Wait, what?
Matt is the motorcycle guy. What was?
He was horrified.
You're going on a motorcycle ride?
No, I was on like a mini golf cart / scooter thing. It's all the rage in Florida, Matt. You wouldn't know.
Well, but there's a question, Matt, especially as the EU reopens a bit. Are you traveling more now, or do you just basically stay home, hang with the baby?
I mean, we do. I come to work every day, but my wife does travel back and forth from Germany to Spain. It is still fairly complicated, but I think it's getting easier. So hopefully this summer there will be a lot more intra-European travel. But the best part is that our friends and family from the U.S. can come and visit us. Did you know that Eric Schatzker is going to marry us in Spain this year?
I did not know that. Congratulations to you. Wait, how is he has a license to marry people?
I'm not sure if you really need a license, and
semantics.
we're already officially married. It's a second. It's a celebration of.
All right, the family of Bloomberg and some insight there, Matt Miller. Thank you for that. In addition to car talk, we now get marriage talk. Coming up, Wei Li, BlackRock Investment Institute Global Chief Investment Strategist, will talk about the great reflation, perhaps turning into the great unwind, with stocks pretty much more abound here ahead of the open. This is Bloomberg.
It's looking more and more like sustainable real growth, and that says a lot for the stock market.
Behind the scenes there, we're going to see probably a little bit more disruption in the reflation in the equity story.
Could we have several years of much higher inflation? Yes.
Danger is upon us, really, in a sense. And that behooves action. And I think the Fed did the minimum.
The Fed doesn't know either when this transitory notion is going to go away.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning to all of our viewers and listeners worldwide. This is Bloomberg Surveillance live on Bloomberg TV and radio. Romaine Bostic here, in for Jonathan Ferro, Lisa Abramowicz, in for Lisa Abramowicz, and Taylor Riggs here, filling in for Tom Keene, who I believe is off observing Juneteenth.
Yes, very nice, Romaine. Happy
Sure.
Juneteenth
Thank you.
to
Nice
you.
to see
and
you, Taylor.
Way
I don't get
to
to see you
join
nearly
us
enough.
at 7 a.m.
Takeover.
I know. This is the takeover.
Closed takeover.
The closed takeover. Yes, Lisa. It's going to be a wonderful 2 hours as you have to deal with Taylor and I talking about standard deviations all day long.
Really? Is that what we're doing for the next 2 hours? Well, standard deviation has definitely been in the bond market, and I will say that Taylor and I have been talking about this morning, Romaine. There also has been, though, in the stock market where you've seen that rotation back into growth. Kind of fascinating, given that so many people left it to die.
Yeah, I think this sort of reflation or unreflation trade that we're seeing here, it'll be interesting to see whether this is just sort of that knee-jerk reaction to the surprise that we got on Wednesday, and maybe we do gravitate back to that reflation trade, or whether this is a reset and a rethink here of where valuations are, Taylor.
Unbelievable, Romaine. Could it be an un-unch kind of day today in the bond market?
No unch. We don't do unch on surveillance, Taylor. I'm sorry.
It's an un-unch kind of day because it's a non-unch kind of day. We're getting some rate of change, Romaine. We're down 2 basis points on the 10s and the 30s. It is just stunning, sort of the migration lower that we get in bond yields day 2, down to a 208, Lisa. It's just sort of unbelievable as we've talked about the unwinding of some of that reflationary trade, not only within the world of the equity markets, but within the world of bond markets as well.
Is this what you guys do in the close?
Yeah.
Ununched?
Yeah.
Standard deviation,
Lisa,
like a
this is what I
non-unch.
deal with for 2.5 hours
Got
every
it.
afternoon here. So prepare yourself here. I mean, look, we are looking here at 4207 on S&P futures right now. We talk a lot about how the S&P had really been in a relatively tight range. It still remains in that tight range, despite the fact that that bid you saw come into it a little bit earlier here. Obviously, you're seeing now a lot of those big cap tech stocks get bid. We had the NASDAQ, of course, and the NASDAQ composite at those record highs. And of course, Lisa, a lot of talk really has to be done today and really going forward here about just the spectacular drop that we've been seeing in the commodity space, particularly with some of those soft commodities and some of those base metals.
Yeah, the soft commodities, just shocking how big the sell-off yesterday was. I believe one sub-index of grains, the biggest decline since 2009 yesterday, just to give you a sense of what the commodity action has been like. Today, there isn't a lot going on with respect to news, but it is triple witching, which is the third Friday of every third month. You have the expiration of a bunch of options and futures contracts on the equity indexes and equities themselves. This leads to more volume. It leads to more action. Is it going to be to the downside, to the upside? Does it matter? This is one of the debates that has been raging on Wall Street for a long time. 1 p.m. we get Baker Hughes U.S. rig count. Interesting to see whether more rigs will come online as prices have climbed despite the slight cooling off in prices that we've seen recently. Discipline has been the word of the year when it comes to the shale patch, and a lot of people expect that to continue. And today, as Romaine was mentioning, Tom Keene off celebrating Juneteenth. That is the word from Romaine. That is the break exclusive today, this morning. The idea here is the celebration of the end of slavery in America. This week, President Biden signing into law this official holiday. So you've got a lot of federal government employees who have the day off. You have a number of banks saying to employees, you can take the day off off. However, even the Fed staff not in the office, but Fed operations still going because there weren't enough provisions made to allow markets to close. That is a more complicated process, and this holiday was just passed into law. It kind of raises this question this year of, can people take the day off? Can they not in the private sector? What should banks do from a public image standpoint? Romain, I got to say, it's going to be interesting to see going forward what kind of policies they put into place.
Yeah, it'll be interesting. Obviously, this came on short notice for a lot of folks in the market. So definitely a lot of folks at work today. And of course, a lot of folks really have to assess what happened on Wednesday and what could happen going forward. Of course, all the big head honchos over at BlackRock, when they want to get a sense of what's happening in the market, of course, they turn to Wei Li, Global Chief Investment Strategist over at the BlackRock Investment Institute. And I'm pleased to say Wei joins us right now to talk a little bit more here, Wei, about this shift in tone that we got out of the Fed. And I'm wondering if this requires a meaningful shift in tone out of the markets.
Well, we actually see what the Fed announced this week in line with its new policy framework. So this bringing forward the lift-off as well as adjusting inflation expectations higher, especially for this year. We also see this adding to the credibility of its framework, because everything that's happened so far, what they have put out, is still in line with what we call the new nominal theme, which is that the rate path will be a lot slower in this cycle in comparison with previous cycles. So if you think about back in 2015, when we're looking at Fed rate hike, core PCE was just above 1.2%. And now we're talking about a lot higher levels, and at the same time, lift off not until 2023 by Fed's own estimate. So we still see their new policy framework very much intact, and that underpins our pro-risk view.
So just to underscore what you may be saying here, is it just that you have not changed anything about your investment thesis post the Fed meeting that a lot of people thought was a pivotal shift?
Well, I would say that there are specific kind of views around, for example, where the dollar could go from here on, at least in the near term, and that has read across to emerging market sentiment, which we are reviewing very, very closely. And more broadly, the view around curve steepening after this week's announcement, have seen reversal of that. So there are under the surface nuances that we're working through, but the overall stay invested in market pro-risk, that is intact, because we still see, even though it came as a bit of a hawkish surprise, the changes and the announcement in line with the new policy framework that the Fed embarked on.
How are you thinking, though, about the rotation sort of back into growth out of value? How much of that was maybe just some recent underperformance that we have seen? How much of that is more fundamental, that long-term growth expectations might be lower than some of our early lofty projections?
I would say, yes, very interesting indeed that we're seeing a bit of a rotation back into the growthy names that came a bit more under pressure earlier on in the year. In our view, for example, the typical growthy names, tech, there is always a place for technology in portfolio, especially when you look at it from a longer term perspective. If you think about some of the structural challenges that we got to tackle, aging demographics, the global green transition, technology will play a big role. Their earnings are good, and they have continued to deliver. And we actually have been talking about kind of earlier year underperformance as interesting entry point to build that position. So the longer term case for growthy type of names, and especially technology, in our view, stays intact. But in the near term, we still see there being more to go in this restart narrative. If you think about kind of the restart that started earlier this year in the US, now broadening out to Europe, and also broadening out to Japan, I do see that there being more to go for the cyclical trades to go a bit longer.
Well, let's talk a little bit more about some of the growth prospects in Europe. Right now, we are getting headlines from the Italian Prime Minister, Mario Draghi, saying that economic forecasts there will be revised up significantly. He's also talking up the need and his desire here for additional economic stimulus here, kind of on the same note that we've heard from Draghi for quite some time. But we've seen better data starting to come out of Italy and some of the other European nations here that I think would be encouraging, Wei.
Indeed, what we have seen so far is that the momentum of restart, the baton is getting passed on from the US to the laggards, previous laggards, including Europe and, in our view, Japan. And that very much underpin our preference to potentially broaden out our previously very kind of strong conviction in US equities and consider some of the laggards, including Japan and including Europe that you just spoke to. One thing I would say, though, is that the restart is very different from a typical recovery. So as we see these very strong incoming growth numbers, we have to take it with a pinch of salt as well, in that we cannot extrapolate this momentum indefinitely. So we caution against extrapolating the very strong momentum that we're seeing right now, but we do see that the restart broadening out, benefiting cyclical assets such as Europe and Japan, for that matter.
Wei, before we let you go, just 20 seconds here. Do you think that the dollar will continue to strengthen after 5 straight days, the greatest strengthening streak going back to May 26, 2020?
Well, we actually see dollar kind of range bound. The recent kind of strengthening trend came off the back of a period of weakening, right? So earlier at the beginning of the year, because of US exceptionalism, we see dollar strengthening, and then we see that coming back, and now it's rebounding back a little bit. We see it range bound, not breaking out of the current range and not particularly hurting risk sentiment. But in the near term, given how strong it's rebounded back, we definitely keep a close eye on risk market because of that.
Wei Li of BlackRock, thank you so much for that. And Romain, I really am curious. I mean, this has been the ultimate pain trade, has been the dollar. Weak dollar heading into the year. Then it strengthened, then it weakened. I mean, honestly, people can't get this right.
Yeah, and this seesaw that we've been seeing to it, obviously a lot of that is tied into people's theories on this economic recovery here. But if this does persist, and I'm not sure any strategist yet is saying that we are going to have meaningful dollar strength, at least above the current levels here, it'll be interesting to see how that feeds in to some of the equity repricings.
Yeah, meanwhile, I'm looking right now. I keep going back to this, a Fed balance sheet, Taylor, of $8 trillion. The fact that they say they're going to taper, they are doing anything but.
Yeah, they are. Sorry, I thought that there was going to be another word. Anything but that, Lisa. And I think that's an important distinction, that a slowing down of the easing is not a tightening. And there is a key distinction there, the same way that Wei Li really nailed it, that a restart is not a recovery. And so you're getting all these upward revisions in economic growth forecasts. Yeah. Though that does not mean anything about sort of the long-term growth expectations.
You know, Taylor, either that chair is really big or you're really small.
Well, yes, she's in the hot seat. She's in the punishment chair.
That's the Tom
She's going to be
chair.
in her own room. Right now we're seeing...
Tom? Is Tom awake yet?
Probably. I think so. We're seeing right now markets pretty much range-bound, trying to reassess the reflation. Is it on? Is it off? The S&P deteriorating as we head into the open. Coming up at 8, James Bevan of CCLA joining us for his investment outlook. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Let's start with more options for US tourists. The European Union has lifted travel restrictions for American residents, adding the US to its so-called whitelist of countries from which non-essential travel is allowed. The new rules mean that EU countries are able to allow quarantine-free travel from the US independently of vaccination status. Also added were Hong Kong, Lebanon, Serbia and Taiwan. Now, Iranians are voting today in a presidential election that is expected to see a hardline conservative replace the more moderate Hassan Rouhani. That could complicate efforts to restore a landmark nuclear accord that has major implications for Middle East security and oil markets. The election turnout is expected to be at a record low and will all but ensure the victory of a 60-year-old Ibrahim Raisi. Now, Russia's Gazprom says a methane plume that was detected earlier this month over the country was caused by emergency repairs that forced the partial shutdown of one of its pipelines. The gas giant said the repairs on June the 4th released 2.7 million cubic meters of methane. The Environmental Defense Fund says that has about the same short-term planet warming impact of 40,000 internal combustion cars in the US for a year. Global news 24 hours a day, on air air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
By making Juneteenth a federal holiday, all Americans can feel the power of this day and learn from our history and celebrate progress and grapple with the distance we've come, but the distance we have to travel, Jim.
President Biden yesterday announcing a new federal holiday of Juneteenth. Today would be the official day that federal employees would have off, and they do. Banks trying to reset and understand how to handle this with their employees, allowing them to take off, though the markets still are open. It is amazing to see how President Biden immediately gets thrust back into the beltway politics of infrastructure as soon as he gets off the plane from a sojourn over in the European Union. Emily Wilkins, Bloomberg government reporter, there does seem to be some progress here on a bipartisan bill. We hear more and more that there is optimism around getting something done sooner than later. What's changed?
What's changed is 10 Senate Republicans. That has always been the golden number on any type of legislation that really needs to get done. When this bipartisan group came out earlier in the week and said, hey, we have something, it was only about 5 Republicans. They said, you need 10, they've got 10. And so that's making people look at this proposition very seriously. At the same point, we haven't seen the exact details of exactly what senators have laid out while we're hearing more and more information. It's a devil's in the detail type thing. There's going to be a serious discussion on what the pay-fors are, on what is and isn't included. And there's going to be a larger debate if they go forward with this bill. How much are Democrats going to need to put into a separate reconciliation package with their own priorities? Will that be possible? Lots of unanswered questions still. No surprise that President Biden got right back into this very soon after his plane landed.
We know that Joe Manchin has been very much in the forefront of the power struggle here in terms of swaying the Democrats and being the swing voter, as he does skew on both sides. Where are the other power centers that we should be watching?
So you do have to keep an eye on Joe Manchin. You do have to keep an eye on Arizona Senator Kyrsten Sinema. But really, to a certain extent, you need to keep an eye on every senator, because even if you get 10 Republican senators and then you have one Democrat who says, you know, I'm not happy with this, I'm not gonna vote for it, that's going to be a problem. You need those 60 votes. And we talk a lot about the Senate with good reason right now, because that's where the crux of negotiations are occurring. But don't forget, in the House, Democrats only have a 5-seat majority. And you've already seen various coalitions of lawmakers, Democratic lawmakers, come out with concerns about what they've seen in President Biden's plan. And so you're sort of at this point where even as a potential bipartisan compromise is emerging, you really still have a lot of details left to negotiate and to figure out to make sure that this bill does indeed have enough votes to actually pass both chambers.
Yeah, it'll be interesting what transpires here over the next couple months as Biden deals with some of these domestic issues. Emily, of course, at some point he does have to circle back to those international issues. And we heard from, I believe, Jake Sullivan yesterday, and the idea here that Biden and Chinese President Xi at some point have to sit down and start to address their differences here. What do we know about the timing of that?
We don't know a whole ton at this point, either about timing or about exactly what format potential talks will take. But we did hear Sullivan say yesterday, as you mentioned, that they want to do sort of something similar with Biden and Xi Jinping as they did with Biden and Vladimir Putin. Have the two leaders sit down, have them assess where their countries are, have them talk a bit about the relationship. I think the difference is that for President Biden, China really is the center of his international diplomacy. It's the one country that he's focused the most on. We saw that at G7. We saw that at NATO. We've seen that with his executive orders. And so I think even more so than the summit with Vladimir Putin, whatever the White House decides to go forward on in their discussions with the Chinese president is going to be very central to the next 3 years of Biden's presidency.
And hinting, of course, Emily, that democracy is under attack. And so much of the infrastructure bill is not only to take on China, some of the technology, the broadband, the 5G investments, but Perhaps maybe to also prove that democracy is still the right way. It's still the way to get things done. How do the relationships with China fold into actually getting a bill done to show that, yes, democracy works. Yes, we can get something done. Yes, we can invest in our infrastructure.
I mean, Taylor, President Biden has already invoked China numerous times when trying to pitch this infrastructure package, and with good reason. I mean, you look at Congress, so many things are stalled in gridlock right now. One of the very few bills that's actually moving is a bill that would help bolster U.S. research and development with the idea that it would help make the U.S. more competitive against China. And so you have that bill that moved out of the Senate is now being dealt with in the House. You have the infrastructure bill as well, which has already, as you mentioned, been pitched as something that would help the U.S. against China. I mean, bills that sort of bolster the U.S. versus China, help U.S. competitiveness, they have strong bipartisan support in a very, very partisan Capitol Hill. So I think these proposals, they've got momentum, they've got the will to happen, and I think you're going to be seeing more of them as time goes on.
Emily, so yesterday we had some critical decisions here out of the U.S. Supreme Court here, including on the Affordable Care Act. While they weren't necessarily a surprise, there are some people that seem to suggest right now that the messaging right now coming out of the court is that maybe it's not going to be as divisive as I think some people thought this court might be with regards to some of these hot button issues.
Absolutely. I mean, remember when Justice Amy Coney Barrett was going through her hearing process, one of the big messages that Democrats had against her was, if she is put in the court, then we're going to have troubles with the Affordable Care Act. And we did not see that yesterday. We saw Coney Barrett join the justices in upholding the law. And so I think this is always the thing with the Supreme Court, right? You do have those conservative justices versus the more liberal justices, but they don't split exactly down party lines for decisions. And it's the Supreme Court, right? They come out with their opinions. They tell you how they got to there. I think it just serves as a reminder to everyone that to a certain extent, the court is still an independent body, despite the hyper-partisanship that we've seen develop around the nominations of these Supreme Court justices.
Emily Wilkins of Bloomberg Government, thank you so much. Let's reset here with a market that's trying to find direction after the Federal Reserve gave a hawkish surprise to markets. We are seeing a deterioration here with actually NASDAQ now lower on the day heading into the open, the S&P increasing its decline. Definitely a move here. There is a softer feel as people reassess the outlook. And I'm wondering, Romaine, is this concern? Is it fair to say this is concern that perhaps the bond markets are the smart money, that they see something that isn't so great in the economy and that perhaps stocks are waking up to that reality?
Yeah, and I think you even saw that even before we got to the Fed meeting, that the equity market was starting to sort of wake up to what the bond market was already pricing in here. And again, you're not really seeing a huge rotation out. And of course, the latest data we got on inflows for the week, which of course are a few days behind here, still shows a lot of cash coming back into the equity market. But where it goes, Lisa, it remains to be seen.
It's not going into junk bonds. I will say that. It had one of the bigger outflows of the year in the past week. And you are seeing a bit of softness, but nothing to write home about. The market's still trading at very elevated valuations here. I'm Lisa Abramowicz alongside Romaine Bostick, Taylor Riggs, Tom Keene, Jonathan Ferro off today on this Juneteenth. And this is Bloomberg Surveillance. Good morning. We made it to Friday. This is Bloomberg Surveillance. Taylor Riggs, Romaine Bostick. I'm Lisa Abramowicz. John Ferro, Tom Keene off today. We are looking at markets that are reassessing perhaps the concept of reflation. That has been faded, and now the question is, how far does it have to go? Yes, we see futures deteriorating a bit on the S&P. The NASDAQ pretty much flat on the day. The dollar a little weaker today after 5 straight days of strengthening, the longest stretch going back to March 2020. commodity and crude a little off the highest level since 2018, but really it is the yield picture, the idea that longer-term yields are coming in on this Fed idea that perhaps they could be more hawkish in the near term. Basically, they hike rates in the near term. That slows growth, and it potentially gives more of a sense in the bond sector that there could be value there. Taylor, I wonder how far this has to go and how much, if you talk about the second derivatives, if you want to go calculus, you could talk about whether people are going to start saying, you know, the bond move in and of itself may convince the Fed not to move too early.
Can we do derivatives at 7:30 a.m.? I guess so, considering it's what? 2 p.m. in London.
If you could say
our other
maybe we can do
headquarters
derivatives
that Romaine really loves. Lisa, but you hit it spot on. We get a note in from Ian Lingen of BMO Capital Markets in just the last few minutes, really saying that some of the yield drop, bond price higher that we've seen shows that employment is improving, but it's not at that breakneck speed, Lisa, that we talk about with some of the economic data. And, well, there is some relative attractiveness of U.S. Treasuries versus still the negative rates that we've seen overseas. And, well, the transitory narrative, it has sufficient buy-in at this point. And I think it was Wade Lee over at BlackRock who really nailed it, that the faster you restart now, the slower the recovery is later on, because you can't have that really high GDP growth forever.
That's very much the case. However, meme stocks can go up forever. Romaine Bostick here with all of the memeology and what's going on.
All right, well, when we talk about some of the individual movers, this is setting up to be kind of one of those hodgepodge days where a lot of things are going to go in a lot of different directions. We start off with the airlines, Delta, United, getting a little bit of a bid here. The European Union, of course, lifting travel restrictions for a whole host of countries, including the U.S., as well as a few other locales like Hong Kong, and, of course, Tom's favorite, North Macedonia, also on that list here. Keep an eye on that. Keep an eye also on the commodity space, because we talk about this massive move that we saw in bonds following the Fed. We also saw a massive move in the commodity space. Of course, that took a lot of the companies tied to metals lower here. U.S. Steel down again here in the pre-market, down about 0.6%. Copper companies also a little bit lower this morning, including Freeport-McMoRan. However, gold companies like Newmont Mining getting a slight bid as we're seeing a little bit of a rebound in spot gold. Spot gold up about 1% here this morning. Flip up the board because we have to talk about what's going on with tech. Tech actually got a really nice bid over the last couple of days. NVIDIA, which of course hit a record high on Monday, hit another record high on Thursday, now up 0.9% here in the pre-market, 753. That's the read right now on NVIDIA. When you look at some of the other tech stocks, so it is a mixed bag. Intel going lower here, a slight downgrade is in price target over at Jefferies. That stock down about 0.4%. Some concern here about competition and its ability or lack of ability to keep up with AMD, ARM, and some of the other competitors out there. And then in the software space, a lot of software stocks did get bid higher as well over the last couple of days, including Adobe. Adobe higher here by 3% after it gave a peek at its results. Those results seem to encourage a lot of investors here that some of those bookings, particularly with those cloud bookings, continue to be on pace, Lisa.
Romaine, thank you so much. Our Northern Macedonian correspondent, Tom Bemelmans, thanks you for the reference. Meanwhile, it is very much away from stocks and into bonds, and I'm not biased, although I kind of am. But this is where the action is, and frankly, it's driving a lot of the sentiment around whether we're reflating, whether we're disinflating, or whether we're just in this Goldilocks period for the long term. Parag Garvey covering it all, ING head of global debt and rate strategy. And as you look through the years, there is a question of whether we are in a paradigm shift, whether the Fed is perhaps addressing a real inflation fear that is percolating in markets and is going to start tapering sooner, or whether this is just evidence of a split Fed recognizing all risks and they're going to keep the status quo.
I think it's evidence that the bond market has its own brain. It's a very shrewd operator. I think if you look at what bonds have been doing over the past couple of months, in fact, right back to March, they have been questioning where we're heading to into the medium term. There is no debate about 2021. This is a real reopening factor. It probably persists into 2022. But the big question mark is, where are we going to be in 2023? The Fed this week told us that they will be hiking rates. The bond market is saying, well, hold your horses here. We're not so sure about that. And that's not been a recent view. It's been there literally for months.
Did you change your view at all, your investment thesis post-Fed today?
No, despite the fact that I'm a bond market analyst and I'm looking very carefully at the dynamics and I'm looking at the discount, we're relatively upbeat. 2023, right out as far as 2023, to us feels pretty good. It feels there's a growth inflation dynamic there. It does look highly likely that the Fed will hike out there. But it's beyond that that worries us. And that's what the bond market is telling us, especially when you look at things like the big negative real yield right out the curve.
Pork, obviously, we talk a lot about the move that we saw in sovereign debt itself here. The move that we saw in corporate debt was a little bit different here. And I'm curious as to what the general thinking is right now with regards to some of those issues.
So the general thinking with corporates is that they offer a bit of a pickup versus treasuries. They are a classic carry trade, which has been the winning strategy since March this year. Just buy the market, funded long, fixed rate receivers on swaps where you receive fixed and pay float to reduce funding costs. I just looked at the data today. There was a big inflow into long dated corporates last week for the first time in a number of weeks. So it looks overvalued, it feels overvalued, but it's a steady carry play. And that's the way I would see it persisting, especially given what's happened over the past few days.
And with regards to the direction of the dollar and how that feeds into it, I remember sort of, I believe it was kind of at the end of Q1, you had seen the dollar just take off here. We were up, 3% or so in terms of the strengthening versus the major currencies here. Obviously, we're nowhere near that now, but you're starting to see, at least this week, a lot of people start to bid the dollar back up versus the euro versus the peso here. How much does that then affect the thinking in the fixed income market?
Yeah, I would separate the two, to be honest, Romain. I think the dollar has had a good pop this week. I think what's happening here is that if you look at dollars from a global context, if you're sitting in Tokyo or Frankfurt, you don't care about US inflation. What you see is a 1.5% 10-year treasury yield. You're going to have some of that. That pushes up the dollar. The problem for the dollar, however, is if you break out that 1.5% into real and inflation, what you have is a negative real yield, which is negative for the dollar, and you have high standalone inflation expectations, which is also negative for the dollar. So that's why we feel the dollar does weaken going forward. Not structurally, but certainly over the next few quarters.
Are these all absolute or relative plays, not only with the dollar, but I'm also thinking about the 149 on the 10-year. Absolute, does that look fairly valued? Or relatively, is it just better than negative 20 basis points in Switzerland and Germany?
Yeah, no, it's a good question. It depends on where you sit. If you're sitting here in the US, 1.5% is awful because core inflation is up close to 4%. It's a big negative real yield. If you're sitting in Tokyo, it's happy days. I'm sitting there in Tokyo with my negative inflation and I'm getting a positive yield of 1.5%. And the problem for that player is that they can't synthetically create a better vehicle because the rate differential has collapsed. Before they could have, but now the best game out there is 1.5% dollars. It looks good.
Interesting. Just a final question here. I am curious. Should we be seeing you've talked a lot about the negative real rates that we continue to see, negative 81 basis points on the 10-year. Should we be seeing real yields be moving more?
The big move this week was in real yields. They popped higher. I like that. I mean, I'm a bond market analyst, but I do like positive outcomes. And what I want to see, if we're going to believe in a positive structural outcome from this awful pandemic, is for that real yield to become far less negative. It can't stay here. This is not sending a very positive discount. So we do believe that does trend higher. Medium term, it should be closer to zero. And even there, it's too low. But at minus 80 basis points, it's sending a very, very negative signal about the future, unfortunately.
Park Garvey of ING, thank you so much. Head of Global Debt and Rate Strategy with, dare I say, the smart money, Romain.
Yeah, absolutely. First of all, congratulations, Lisa. We made it 40 minutes into the show, and Taylor and I still haven't actually upset you, which is pretty good here. But we don't.
She's in the timeout chair. That's why she's in the other room. So are you trying?
Yeah, she's in the big Tom Keene chair there. Yeah, I mean, look, he hits a lot of good points here, particularly at the way a lot of foreign investors sort of look at what's happening now. There's still a lot of money to be made here. We could talk about the drop in yields. We can talk about the pullback in equities here. But the way that folks have sort of positioned themselves themselves in this market heading into this year, I think has set them up for the idea that the Fed was going to move, or at least telegraph that they were going to move. The fact that maybe we got that communication maybe a couple of months early, I don't think really changes the overall thesis.
Well, although I do think that there was a market shift. Let's be clear. A significant increase in the number of members of the Federal Reserve that brought forward their expectations for rate hike, Taylor, to 2022, to 2023. The idea here that you actually have 13 out of the, I believe, 18 members that now say that you should raise rates versus 7 at the last meeting. I mean, what was the big difference? What have we gotten data-wise that changes that other than an increasing number of naysayers in the market speculation?
And most of the economist notes that I've read said that they knew that the Fed needed to say something, given we're not in an emergency anymore. We can pull back on maybe some of these emergency measures. But then there's also this tone that, well, the Fed is always dovish, so we don't actually think they'll do it. And I believe it was Rick Reeder that said, wow, they actually did what most market participants thought that they should do. And, well, we're all a little bit caught off guard.
I will say this, and Romaine, I dare say I'm going to editorialize here.
Okay, go ahead.
Ooh. But I think that they did the right thing, because basically they created a little unease in markets that perhaps were being accused of frothiness. And so the idea here of trying to engage some sort of perhaps discomfort isn't bad. He's just like, let you hang. He's going to let me hang with this.
I let you editorialize,
An
Lisa.
editorial
I stick to the fact, just the facts.
Oh, all right. Well, I'm going to weigh in. Anyway, coming up, Matt Hornbach is going to weigh in as well, and he can perhaps push against me. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Now, firstly, coming up, North Korean leader Kim Jong-un said he is ready for both a dialogue and confrontation with the United States. This as President Biden's new nuclear envoy heads to the region to build support for a strategy towards Pyongyang. It is the first high-level suggestion of talks since Biden replaced Donald Trump, who did meet Kim Jong-un 3 times. Now, Chinese officials are drawing up plans to further loosen childbirth restrictions and transition towards policies that encourage childbirth. Dow Jones reports that policymakers are discussing the possibility of fully doing away with birth restrictions by 2025. That reflects Beijing's increased urgency as economic growth slows and China's population does grow older. The coronavirus pandemic is showing no signs of slowing down in Moscow. The Russian capital reported more than 9,000 new cases today. Officials are extending some restrictions on public activities until the end of June to contain the outbreak. New infections in the city have tripled in the last 2 weeks as the highly contagious Delta variant does spread, in part to low vaccination rates. And Israel has agreed to send about 1 million COVID-19 vaccines to the Palestinian Authority in an exchange deal. Israel said it will send Pfizer jabs and then will get a similar number of doses from the next shipment earmarked for the Palestinians in the fall. The move comes after Israel was criticized for not helping to quell the virus in the occupied West Bank and Gaza. Global news 24 hours a day. I'm Leanne Gerrans. This is Bloomberg.
I think we need to approve an exchange-traded product based on Bitcoin, and frankly, we've gotten new applications in on based on ETH as well. And then we need to provide some clarity around custody for regulated entities, so for broker-dealers and investment advisors. So those are some of the areas I'd like us to take action in.
Hester Peirce, SEC Commissioner, one of the most vocal among them about the need for regulation, but also allowing Bitcoin to take hold and setting the parameters for it to do so in a more substantial way. This is Bloomberg Surveillance. Good morning. Tom Keene, Jonathan Ferro, Lisa Abramowicz. Jonathan Ferro off, Tom Keene off, trading Bitcoin with his afterthought. I believe that she is deep into Bitcoin. Romaine Bostick and Taylor Riggs with us. The close taking over the open today as we look at the S&P futures getting deeper in the red, 41.97. We are looking at a 0.3% decline that does seem to be going south, and we've got that 10-year yield also going lower today, 1.4853%, just to channel the out to four digits, and crude off its highest levels since 2018, $70.58 on the NYMEX. You know, we've been talking all morning here about the sort of reflation and the deflation of the reflationary trade. How Bitcoin fits into this, though, Romaine, to me is very unclear.
We'll join the club here.
Speculative behavior.
Yeah, well, speculative behavior. Look, I mean, you're looking at 38,000 right now on Bitcoin pricing here, but you talk about that collapse that we had in mid-May, roughly here. We really haven't bounced back from that. I mean, a lot of people talked about a rebound, but we've basically been where we've been now for the last 5 or 6 weeks here. And I thought it was interesting. There was a great story on the terminal a little bit earlier here, Lisa and Taylor, about some of these hedge funds and the idea here that a lot of them have sort of stayed on the sidelines primarily because they can't model this. It's not that they're not interested in it. It's not that they don't think there's a future for it. But until you can sort of create some sort of fundamental model for it, it's very hard to sort of just jump in. Yeah, they're fundamentals. Remember those?
We don't do those on
fundamentals.
The
close. We don't do this? Yeah, we don't do that on the close. We just do UNT and
in all
Bitcoin
fairness,
and
fundamentals
NFTs.
Could be an Elon Musk tweet. Right now, let's go to the fundamentals of international relations. A Bloomberg exclusive, Venezuela's President Nicolas Maduro having a conversation with Eric Schatzker, our own, of Bloomberg, talking about Caracas and the nation that has been mired in an economic crisis. Part of this has stemmed from, at least you listen to President Maduro, U.S. sanctions. And Eric asked him what changes in policy he would be willing to make in exchange to get some relief. Take a listen to what Maduro had to say.
I believe that the sanctions are immoral. That's the first thing. They are cruel, very cruel for a country. And I think that at a round table of conversation, even if it's private, the United States of America, the Biden administration, should accept it as such, should see it as such. And the sanctions are transformed. As the Human Rights Organization says, the special reporter that came to Venezuela for the matter of the sanctions are transformed into a great violation of the human rights of the Venezuelan men and women. Furthermore, not only is it a cruel mechanism that causes suffering to the people, but it's also a failed mechanism. Failed. Because all the sanctions, in an extremist and irrational manner, were applied by the Trump government against Venezuela for a change of regime. And they didn't achieve it. Nor are they going to achieve it. So the sanctions should be recognized as illegal, irrational, extremist, cruel, and they should be lifted.
In your opinion, Mr. President, but it's still U.S. policy. And it seems to me the U.S. won't change its policy without a change in positions.
Then it's a closed game, Eric, because we have our principles, our Constitution. We have the right to life, to economic freedom, to commercial freedom. Venezuela and the whole world has the right to commercial freedom. There can't be one country that, because of the control of the currency and of the banking system, imposes to the rest of the countries of the world what should happen in their country at a political level, who should govern or who shouldn't govern. If that was established, Eric, it would simply be the end of the United Nations system, the end of the international law. No, the United States must recognize that an international law exists, that a multipolar world exists, that another world exists, and furthermore, it must recognize, sooner than later, that what they are doing with Venezuela is a brutality only comparable to the Vietnam War and the massacre that they committed against the people of Vietnam. They are committing an economic massacre. Venezuela has the right to freedom to produce oil, to sell it, to obtain profits, to fulfill its international obligations, to maintain the life of the people. Venezuela has the right to produce gold and sell it. Why aren't we going to have the right to do that? Why is the right to economic freedom going to be taken away from us? Why? Someday that will. I have faith. I am a man who believes in God very much. I am a man of prayer and of action. And I have the faith that someday that message is going to arrive. And it's going to produce the changes that we need for a better world, a more human world, a world of respect.
es un problema porque ustedes obviamente no quieren.
That's a problem. Because you obviously don't want to live under the sanctions anymore. You're not willing to change anything?
Es que los cambios en Venezuela se producen todos los días.
The changes in Venezuela are produced every day, but there can't be a relationship in the world where I put a gun to your head and I tell you, act the way I want you to, or I'll shoot you. You can't put a gun to the head of the people of Venezuela, so that from the United States, they'd tell us what we need to do. We would turn into a colony. We would turn into a protectorate. We would kneel down. We would betray the magnificent historical legacy of these giants, like Simón Bolívar. No country in the world, no country, and even less so Venezuela, is willing to kneel down and betray its legacy.
A conversation with Nicolas Maduro of Venezuela with our own Eric Schatzker, an exclusive as he traveled to Caracas to discuss sanctions, as he discussed the path forward for an economy that has been absolutely decimated, not only by the sanctions, but also by some of the policies. I mean, that in the front and center in terms of oil revenues, where they go, and the distribution of funds throughout the country. You know, this really highlights some of the idiosyncratic risk. Yes, you can drink. That was a prior drinking game. But Romain, there is a question of the MSCI Emerging Markets Foreign Currency Index. The idea here that you're seeing weakness in a lot of these areas, especially as we look to the Fed to possibly tighten rates, and sort of a question of how much that could forestall the development that we've seen in the emerging market complex.
Yeah, potentially here. And I mean, and this is a fantastic interview that Eric did. But, you know, to address with some of the things that Maduro was talking about, we're talking about basically what's now been U.S. policy under now a fourth president here. And his concerns, while certainly valid, you have to ask what the U.S. would actually get in return for easing any of those sanctions.
And whether they could get any guarantee into humanitarian outreach. I mean, just talked about the exodus of people from Venezuela to other places as they struggle to get enough to eat. Incredible coverage across the Bloomberg complex on just that. Coming up, James Bevan joining us, CCLA Chief Investment Officer from New York. This is Bloomberg.
Looking more and more like sustainable real growth, and that says a lot for the stock market.
Behind the scenes there, we're going to see probably a little bit more disruption in the reflation in the equity story.
Could we have several years of much higher inflation? Yes.
Danger is upon us, really, in a sense, and that behooves action, and I think the Fed did the minimum.
The Fed doesn't know either when this transitory notion is going to go away.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The deflation of the great reflation, the pendulum of doom shifting. If Tom Keene were here, he would have a head up already. This is Bloomberg Surveillance. Good morning. Happy Friday. On Bloomberg Radio, on Bloomberg Television, John Ferro, Tom Keene off today. I'm very lucky to be graced with the entire close staffs here, almost. Taylor Riggs and Romain Bostic here for this Friday that's really a market shift in the market. And I will say, Romain, we have seen a rotation in a number of different asset classes, yield curve flatter, a rotation back into the growth names, into the big tech names within the equity markets. It feels like a reset.
It feels like a reset, and it is a reset. A lot of people were sort of looking to the Fed to maybe communicate something in August, maybe at Jackson Hole, maybe at their meeting in September. They got that communication a little bit earlier than planned, and yes, that does require a little bit of a reset. So you're looking at a market here that looks like it's going to have a down week, at least for the S&P 500. You saw a rotation out of some of those cyclical names, though. You are seeing some strategists say, look, stick with values, stick with cyclicals. That's still going to be the trade going forward. A lot of investors, though, aren't so sure. They're gravitating to growth stocks, although some of those growth stocks look a little bit more defensive to me.
The pendulum of safety.
The pendulum.
The pendulum
Where
of
is
tech.
Tom?
I can keep going. All right. Romain, there is a question of the pendulum of a shift in equities. Also, with respect to bonds, it's all inflation. And Taylor, interesting to see the tone shifting there, not only among the Federal Reserve, suddenly seeing inflation as perhaps a bigger risk than moving too soon and sort of disrupting the economic recovery in the labor labor market. But we're also hearing that kind of shift within the White House itself.
Yeah, really interesting comments coming out of Jared Bernstein, White House economic advisor, speaking, of course, on another network, saying a few different things, Lisa. We're more concerned about inflation than we were before, then say, never mind, we're equally as concerned about inflation and still very convinced that inflation is transitory. So really trying to hone in that message about being transitory, being on the same page as the Federal Reserve. All as the bond markets respond, Lisa, we migrate downwards to a 148, a 207 on the 30-year. All as I think investors and economists this morning have said, the Fed may not be as willing to tolerate higher inflation as maybe we once thought. That's at least what the tapering, the dot plots show us. Maybe 2.5% might be it in terms of the higher end of that range.
And the gravitational force right now as we head into the open here, about an hour and a half away, 90 minutes, has been lower with bond yields. Right now we're at 1.4768% for the 10-year yield. You could see that shift also for the 30-year. Interesting to see how people are rejiggering their expectations for a Fed perhaps not letting the economy move and get as hot as people previously thought. Just taking a look, though, also at the dollar, and this is interesting. The dollar pretty much flat versus the euro, a little euro strength, but this is a reset in a moment for potential dollar strength after 5 straight days of strengthening, the longest streak going back to 2020 in March. And Romain, help me out here with what we're seeing underpinning the stock move, which actually does seem to be getting more negative.
Yeah, absolutely. And I mean, a lot of it does have to do, I think, with this general sense here that the yield support isn't necessarily going to be there longer term. There is going to be potentially dollar strength. That, of course, could actually erode some of the forward gains here. And just to your point here about the reset, I think anyone at the Bloomberg terminal, you just run a dollar chart here on a year-to-date basis. You look at that spike up that we had in Q1, that drop we had basically at the start of Q2, and now this little bit of a spike that we've had over the last few days. There's your reset. That illustrates it more than anything else.
Yeah, just to give you some sense, S&P at 41.95, the NASDAQ at 14,135. Here we are trying to reset as we head into a summer of discontent. James Bevan is not discontented, CCLA Chief Investment Officer, joining us here. And there's a question of how much you rejigger your expectations going forward based on a hawkish Fed, or how much you shrug off these comments as them trying to talk markets away from getting overly frothy.
I think the Fed is taking a very responsible tack. It recognizes the economy is positively surprising on virtually every indicator. We are going to have a bumpy year economic growth, and therefore a huge year for corporate earnings growth. I'm expecting that the S&P 500 will deliver $200 of earnings this year, and even with Mr. Biden's tax hikes next year, I'm expecting $215. So I remain bullish on equities. I think valuations can remain elevated. I'm looking for somewhere between 4,300 and 4,600 points for the S&P for the end of this year and 4,800 points for the end of next year.
A few months ago, I raised the issue with another strategist about the idea of stagflation, and I was basically told that's balderdash, that's really not in the cards here. Based on what we know now, is that a reasonable possibility?
Well, I do think that we are going to see relatively strong growth for a series of interconnected reasons. That the cash the Federal Reserve and the US government have already paid out to companies and individuals clearly have the capacity to drive growth. And I would look at the CEO investment intentions surveys to say that a lot of people are now wanting to invest in plant machinery and critically rising productivity. And the productivity, I think, will come because as wages go up, so it will be that companies will be incentivized to do more to ensure that their margins are maintained. So what happens on the demand side? Well, all the evidence, I think, is that US citizens have more cash, they have higher asset values, and I do believe that as the COVID-19 crisis moves past, we will see US citizens spending more money. So I am unambiguously bullish in terms of economic activity, but I absolutely concede that there must be at least a 1/3 chance that higher inflation is here to stay. Critical issue being whether wage inflation trumps the investment in productivity.
Talk to us about wage inflation, general inflation. We're getting some comments from the St. Louis Fed, James Bullard, saying that there is some upside risk to inflation at this moment. Are equity markets then the correct inflationary hedge?
I think that people are not really concentrating on the right wages data. I meet a number of commentators and clients who tell me that the average hourly earnings is what I should look at. And I think, the compositional shift of people who are employed makes a big difference. What we're seeing is a lot of relatively less well-paid people coming into the jobs line. The net result is that the average hourly earnings are being pressed by those new people joining the queue. On a like-for-like basis, people in skilled jobs, the more highly paid jobs, are now seeing significant wage inflation. And therefore, I think that when one thinks about equities as an inflation hedge, one has to think about the quality spectrum of the market. One has to think about companies that can both set prices but also control costs. So I absolutely concur with the perspective that it's time to look again at technology, but also some of the international branded goods companies like Kering.
This is Bloomberg Surveillance. So we do not discuss UNCHT, and we do not discuss necessarily standards of deviation, although Tom Keene does frequently. We do discuss a pendula of a variety of different natures, where the feeling is currently in markets. And I'm wondering, from your perspective, whether the pendulum of doom coming from the bond markets, this feeling of perhaps stagflation, is relevant to equities, whether that is the accurate interpretation of this disinflationary trend.
I just haven't seen the pendulum move in the bond market at all. If you said to me, where should the bond market, the 10-year yield in the States be at the moment, I would say by reference to the copper price and the gold price, it should be at around 2.5% as opposed to 1.5%. So I fully expect the 10-year yield to finish this year at 2%, be back at 2.5% by this time next year, none of which I think is disastrous for the equity market by a large margin, because those sorts of yields are simply consistent with the normalization of economic growth, the capacity for companies to deliver the sustainable growth that they absolutely require. I think that the far bigger risk to the market is that after a bumper Q2 earnings season, markets say to themselves, well, we've had an awful lot in the bag. If the Q3 numbers then disappoint, then I do think that there will be a lot of profit taking in the autumn. We know that there will be a reduction in fund flows. So for me, the critical period is the fourth quarter this year, but not because of the bond market, but because people may become overly optimistic, and meltdowns typically do follow pronounced melt-ups.
So, James, at this stage, we can have a real conversation here about the normalization of monetary policy, or at least the potential for it here. Fiscal policy is still a big question mark here. You have, obviously, folks here in the U.S., including Biden, looking to throw more logs on the fire here to stimulate economic growth. You've got commentary out of Europe, including from Mario Draghi, about the need for additional economic stimulus. How does that fiscal policy framework factor in your general outlook right now?
Well, I would make two observations. First, that the fiscal expansion occurs in the context of modern monetary theory, where central banks are supporting low bond yields. If you were to go back to the period when Tom Keene was learning his trade, any government that elected to spend more money necessarily led to much higher bond yields, and everybody was miserable. We're not seeing that because the Federal Reserve has bought more bonds than the Treasury has issued over the last 12 months. And I absolutely believe that this control of the yield curve is a conscious decision, and it will continue to be in favor because Mr. Powell and Mr. Biden both recognize that if they are going to spend a lot of money, it needs to be cheap, and the Federal Reserve can make it exceptionally. So I do believe that Mr. Biden will spend a lot of money. Yeah. I think that if inflation rises, then Mr. Powell will be less tolerant, indeed, as you were suggesting, than the market suggests. Because inflation is aggressive. It doesn't help people at all.
James Bevan of CCLA, thank you so much for being with us. As we've been talking, James Bullard has been speaking, and really one of the most notable headlines, as Taylor, you mentioned, that Powell officially opened taper discussion this week, this according to St. Louis Fed President Jim Bullard. And the question here is how markets are taking this. And if you take a look here, it's actually a pretty significant move. You see futures move substantially lower here on the morning, including the NASDAQ, Romaine.
Yeah, a significant drop lower here. On futures, obviously seem to sync up with those headlines. Of course, Bullard speaking on another.
And leaning that they might not need to be in MBS. There's a $40 billion monthly purchase of MBS that might now be off the table.
And you're seeing actually 10-year Treasury yields inch up from where they were earlier. Coming up, we've got Congressman Sean Casten, Democrat from Illinois. We will carry the conversation forward about rate hikes. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Now let's start with more options for U.S. tourists. The European Union has lifted travel restrictions for American residents, adding the U.S. to its so-called whitelist of countries from which non-essential travel is now allowed. The new EU rules mean that EU countries are free to allow quarantine-free travel from the U.S. independently of vaccination status. Also added were Hong Kong, Lebanon, Serbia and Taiwan. Now in Northern Ireland, the DUP's leader Edwin Poots is stepping down from the largest political party. This move comes just 3 weeks into a revolt that throws into question the future of the power-sharing executive in Belfast. His exit adds to the growing pressure on the DUP, which has seen its support decline in recent opinion polls. California did avoid blackouts yesterday evening, but grid officials are warning that power supplies may be tight again today. That's as a triple-digit heat wave continues to grip the western U.S. California is asking residents to turn off unneeded lights and appliances to prevent power cuts. Temperatures climbed above 100 degrees Fahrenheit across the region. Sacramento hit a record 110 degrees. That was yesterday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Once again today, the United States Supreme Court, in a 7-2 ruling, upheld the Affordable Care Act in the face of another legal challenge. So let me say definitively, the Affordable Care Act has won. The Supreme Court has just ruled the ACA is here to stay.
Majority Leader Chuck Schumer speaking after that Supreme Court ruling having to do with the Obamacare Act. And really, right now, we are looking at Washington, D.C., and we have a fantastic conversation coming up with Congressman Casten, a Democrat from Illinois. But before we get there, I'd love to get a sense of just how significant the move has been as we hear Jim Bullard of the St. Louis Federal Reserve speak, I believe, on CNBC, and remain talking here about officially opening the taper discussion, basically putting a code on this week of Fed speak to basically say, yes, we are talking about tapering, we will begin, and how it's going to begin is really a big question now.
Yeah, these are pretty aggressive comments here. We did see S&P futures dip about 10 or so points. It was already down about 10, 15 points, dipped another 10 off of those headlines here. And it'll be interesting to hear. I mean, we're obviously hearing from Bullard, of course, speaking on another network. He's scheduled to speak at an event around 9:30 New York time. But keep in mind, we're going to hear from pretty much all the Fed presidents here over the next 5-6 days. So it'll be interesting to see what they're willing to reveal about what went on behind closed doors this past Tuesday and Wednesday, and whether they share Bullard's vision here for maybe a little bit more aggressive pace of tightening.
And Taylor, just quickly here, you're talking about the mortgage securities and potentially unwinding that first, and we are seeing markets respond to that. You know, the details are really important for where market pricing will go.
Yeah, you know, Bullard coming out and saying that they're looking at perhaps maybe looking at mortgage-backed securities first. And, you know, Lisa, we go back to December 2013 when Ben Bernanke first announced that taper. And originally it was an equal weight, $10 billion a month. He wanted to look at an equal weight of treasuries and mortgages. That appeared at that time to him to be sort of the simpler way in which to start this. So very curious that we're getting comments this time around the $40 billion of MBS. Nothing yet so far around the $80 billion treasuries per month.
Yeah, and we'll have more on that coming up. Right now, we are so lucky to have Congressman Sean Casten, a Democrat from Illinois, joining us on the drumbeat to infrastructure, the drumbeat to cleaner energy. Congressman, I'd love to start with this idea that there seems to be more of a consensus forming on some sort of bipartisan infrastructure bill. What's your sense of the shift that's allowed a greater consensus and perhaps more optimism around something getting done?
You know, I hope you're right. We desperately need to upgrade our infrastructure. The I don't think it's surprising. Every member of Congress would like to see infrastructure projects to their district. I think the challenge that we have in this moment is to make sure that we do not forget about the critical importance of climate infrastructure in this piece, because as long as the red state, blue district, blue district divide tracks so closely to where people live and where land is, that means that this huge win-win of clean energy that is a wealth transfer from energy producers to energy consumers has a partisan tinge, and we just have to make sure not to let that quest for bipartisanship get in the way of doing what we have to do, both for the environment and for our wallets.
Yeah, well, the partisan tinge, of course, has been a huge roadblock for a lot of efforts out there to address some of these issues, Congressman. You have 3 proposals out there, at least 3, that I'm aware of here, to address some of those climate change issues. I'm wondering whether you can talk a little bit specifically about the one that's supposed to address some of the financial risk that you see out there.
Sure. Well, I was delighted we just passed on the floor this week my Climate Change Financial Risk Disclosure Act, which essentially just says that the SEC is obligated to require all companies on a mandatory and consistent basis to report both their contributions to global warming and their exposure. As I'm sure you know, in 2010, the SEC developed voluntary disclosure, and last year, the Trump-led CFTC said that those disclosures were insufficient, were not providing investors what they need. And so the idea is to get this out there to level the playing field. Again, that one we just passed on the floor this week, and we will send off to the Senate. The other proposals that we have are essentially follow from that, saying we need to understand the systemic risk that climate change poses to our financial system. Swiss Re has said that on the course we're on, we are looking at an 18% reduction in global GDP from climate change. That's the business as usual case. Even if we meet the Paris goals, it's a 4% reduction in global GDP. CFTC has more or less matched those predictions for the United States. And some of that is negative loss. You know, what happens to low-lying coastal areas and properties that are there from hurricanes, from wildfires, et cetera. But a big part of it is transitional, because every clean energy technology we build lowers the cost of energy. Solar panels, electric vehicles, geothermal efficiency, it leaves more money in people's pockets. But that's really disruptive to certain regions of the country. And, you know, as I tell my colleagues, rising tides sometimes lift all boats. Tsunamis have a way of swamping some out. And so we're creating a tremendous amount of wealth, but where is it going to be isolated in our economy from it? So these other bills are designed to say, let's have the Fed, let's have our prudential regulators understand where those systemic risks sit, and then put appropriate guardrails to protect investors when those movements inevitably start to come, as indeed they already are.
Congressman Sean Casten of Illinois, thank you so much for being with us. Too short. We'll get you on more next time to really dig into some of the infrastructure proposal. Really, though, there has been a market move in markets. Taylor, there's a sense here that there is a hawkish tilt that's getting more hawkish as we hear more rhetoric out of Fed members. James Bullard of the St. Louis Federal Reserve, not a voting member, but coming out on CNBC and basically saying that he expects the first rate hike in late 2022.
That's at least what his dots are showing, as you were talking more and more about dot dispersion coming into this meeting compared to previous meetings. And again, sort of the key headline remains, Lisa, within the bond markets, yields are no longer lower. We now have a sort of come flat on the day as we look forward to maybe higher yields on the horizon. Some of the key statements to me, I was just engrossed in the December 2013 release when Ben Bernanke was at the Fed running the Federal Reserve there, really talking about that initial taper of the 85 and 45, reducing treasuries and mortgages by $5 billion each to create a $10 billion taper. And it sort of reminds us about where we were in this cycle, announcing the taper, following it up with the taper later. And this is different. This feels like we thought that we'd get a big runway, and this feels maybe sooner than we thought.
Yeah, it's definitely an acceleration here, and I think that's what's really being reflected, the reaction to Bullard's comments here. You talk about S&P futures, which have just dropped about 20 points or so in less than 15 minutes here. I think when you guys started this show, Bloomberg Surveillance, at the 6 a.m. hour here, we were actually positive on the day. You're seeing, of course, a bid. 6 a.m. I can't remember. 6 p.m. Who knows?
close.
Open, close, it all sort of blends together. You're seeing strength now in the dollar. Remember, the dollar was coming in relatively flat to down on the day. You're now seeing a bid come into that, Lisa, here. So again, this reassessment that we've been talking about all morning, I think as we hear from more of these Fed speakers, that reassessment is going to continue.
Yeah, there definitely does seem to be a hawkish tilt. And there's a question here, how much are we seeing dissonance within the Federal Reserve? More Fed members pushing back against Jerome Powell's
use a lot of big words
goal.
on this show.
You know,
dissonance, paradigm.
We'll just use para. Coming up, Matt Hornbach, he'll weigh in from Morgan Stanley on the latest from the Fed. This is Bloomberg. This is Bloomberg Surveillance. Lisa Abramowicz, Romaine Bostic, Taylor Riggs, Tom Keene, and John Ferro off today. There is a question about Fed policy, just how much its framework did shift this week. If Jim Bullard is representative, St. Louis Fed president, then it shifted quite a bit. Speaking earlier this morning, he said that Jay Powell, the chair of the Federal Reserve, officially kicked off taper discussion this week, and that he basically does see the Fed raising rates at the end of 2022. That is his dot, as reflected in the projections. Of course, he is not a voting member, but he is evidently among the 13 members who do see an earlier liftoff than the rest of the market previously had expected. Peggy Collins, Bloomberg U.S. Economy Managing Editor, joining us now. Peggy, can you give us a sense of how much of a surprise and how influential or not Jim Bullard is as a member of the Federal Reserve?
Well, it is very important, Lisa, because it starts to give us an idea of, as you said, who's on the scale there with the dots and how they are really thinking in terms of their new framework and the tapering discussion. So we saw on Wednesday Chair Powell come out and say this was basically the meeting where we started talking about tapering. And the market really came into focus after digesting that and the surprise in the dot plot to start to think about, okay, will it be Jackson Hole or the September meeting when they actually signal to the markets when they're going to start tapering? And will that be November or December, which seems to be the consensus in terms of when they pull the trigger?
Peggy, I'm trying to understand messaging. I just finished reading Sebastian Maldives' book on Greenspan, talking about being a manipulator of the media, hinting, putting people out in the media to sort of get a feel of how the markets might respond. Am I reading too much into this? What is the messaging behind putting Bullard out on a Friday morning?
Well, Bullard often comes out and is more aggressive in his calls potentially or outwardly to the media with his calls than some of the other regional Fed presidents. So in that sense, it's not a complete surprise that he is putting his opinion out there. But I think it is helping to clarify where some of the board members and the regional Fed presidents are.
So then, Peggy, look ahead for us. I mean, I think we're going to hear from Williams a little bit later today. And next week, you got Mester, you got Daly, Bostic, Rosengren, pretty much everyone of importance here on the Fed and FOMC scheduled to sort of speak publicly here. Do you think that we're going to hear a similar tone out of those names that we're hearing from Bullard today?
Well, I think we may start to see a different tone from some of the board members. I mean, Powell had a more reserved tone on Wednesday, despite the surprise, and the surprise was really in the dots, not in terms of the tapering announcements that they were making and signals they were giving. It was really that we got two dots in 2023 or dots for two interest rate hikes, I should say, in 2023. But Powell was certainly, a bit more reserved. So we'll see if some of the other board members have that tone as well. But I think what we're now starting to pull into focus is how did this increased rise in consumer prices, this inflation debate that we're seeing, how is it influencing the Fed potentially faster in pulling forward some of these decisions faster than they might have expected earlier this year? And it really puts the jobs data in focus over the next couple of months.
Peggy Collins, Bloomberg U.S. Economy Managing Editor. Thank you so much for that. And we should just note that as we were speaking and as the market does digest what these comments say, you are seeing yields, as Taylor was mentioning, go up, particularly at the long end. 30-year yields now 2.1%, 10-year yields now up to 1.52% or almost to that. Matt Hornbach, Morgan Stanley head of global macro strategy. You are the right person to be speaking to right now to understand how much this is indicative of a broader Fed policy. What's your take on these comments out of Jim Bullard?
Well, thanks for having me on, Lisa. I'm not surprised that President Bullard is making headlines. He's done that quite often in the past. I think what is more surprising is the degree to which the Fed is linking themselves to realized inflation data that they themselves are suggesting will be transitory. I mean, in some sense, their new monetary policy strategy, which is suggesting that realized data usurps forecasted data, that's the type of strategy that could lead them down the wrong path very easily, especially when even the inflation expectations gauges that they're so focused on have shown a very high degree of correlation with year-on-year rates of inflation. So at the end of the day, they're looking at the same thing, and it might be leading them down the wrong path. I think some of those aspects of this new policy strategy are what the markets are keying off on today.
Yeah, that's the part that kind of confused me after Wednesday's announcement and press conference here, Matt, was this idea here that for months they've been telling us don't really pay too much attention to some of these inflationary pressures, focus a little bit more on the employment picture, and we'll all sort it out somewhere down the road in 2023, 2024. There does seem to be a message now that maybe we should have been paying attention to this. Is this actually a shift in policy, or is this just simply misdirection?
Well, Romaine, you're not alone in confusion there. At the last press conference, Powell essentially paid lip service to inflation and focused a lot on the labor market. I think he did the exact opposite earlier this week. He paid lip service to the labor market and spent a lot of the time focusing on inflation. To me, this isn't really a change in their monetary policy strategy or reaction function. This is actually an execution of that strategy to focus on realized data at the expense of forecasted data. This is the pendulum swinging from one end of the spectrum, where Yellen essentially made policy based on forecasts, to the other end of the spectrum, where now they're making policy based on realized data that may end up proving transitory over time. That's the issue here.
Matt, I am curious about asset price bubbles. Perhaps if some have linked to massive M2 money supply, the liquidity sloshing around in the system, the forced risk taking that is going on. Jim Bullard, of course, this morning saying they're watching the housing market. That's been a key area of concern. Crypto markets, that has nothing to do with inflation, he says. But do you see pockets of some of these asset price bubble-ish tones?
Yeah, well, I mean, certainly you can look at certain markets and come up with a variety of conclusions. My sense is that there's a lot of liquidity in the commercial banking system. We can see this pretty clearly in the Fed's overnight reverse repo program. So the liquidity is abundant. The question is, where does it go and when does it go there? And how high are the prices? How high do the prices go when the liquidity pays a visit to some of these markets? Look, cryptocurrencies are really the poster child for this type of behavior. It's not. I mean, who knows how high these prices can go? They can always go to zero, of course, but this remains to be seen. So I'd say, look, there are pockets of excess liquidity influencing prices, but then there are other markets that look very reasonably valued to us.
Matt, what's the message from the bond market this week?
Look, I think the message from the bond market is the Fed has to be very careful about its communications, not just verbal communications, but all types of communications, including the communication that's coming from the dot plot. The dot plot does not represent today what it did back in 2012, even though Chair Powell has tried to get that message across with consistency. Not everybody's hearing it. And so they need to take a second look at the dot plot, figure out what to do with it.
Yeah, okay, so it's a bumpy ride ahead. Let's talk about positioning here, Matt. And I mean, what do people do right now? If they look at the messaging that we're getting out of the Fed now, and they look at the current state of affairs with regards to pricing in the bond market here, I mean, do you abandon some of those short bets that you had? Do you abandon some of those steepener trades? Do you bet on the dollar? What do you do right here?
Yeah, absolutely, Romaine. Look, I think you certainly have to give up on the curve steepening trade. From our perspective, it was mostly a carry and roll down opportunity that the Fed put to bed earlier this week. So we can no longer advocate for curve steepening positions. Really, we think there are two opportunities here in the marketplace. Number one, to be long the US dollar. That seems to be the clearest expression of what we're getting out of Fed policy today in concert with the economic data that we expect. So the dollar should continue to move higher. That's massively out of consensus at this point. Number two, real interest rates in the US are also going to continue to move higher. That means the TIPS product is going to underperform. So we like selling TIPS, and which might sound odd to people given the inflationary environment, but coupled with Fed policy, we think that TIPS are going to underperform. So we like being underweight in that part of the fixed income space.
Talk to me, Matt, finally about the dollar, because the shift to dollar strength is a very stark contrast to coming into 2021 when everyone was short dollar. It was dollar weakness that was the call. When did that shift happen for you?
We actually turned neutral on the dollar in the first week of January. And our perspective there was that, look, there are differences now in how the interplay between real interest rates and break-even inflation rates would evolve. In 2020, real interest rates were going down, break-even inflation rates were going up. That's the perfect environment for dollar weakness, which is exactly what we got. Now, coming into this year, you stop seeing real interest rates going down. They started going up alongside break-evens. That is an environment where the dollar moves sideways, which is exactly what happened. Now we're moving into an environment where we think real rates go up, break-evens go down. That is dollar positive. That's one of the reasons why we're long the dollar here.
Matt Hornbach, a perfect guest at a perfect time. Morgan Stanley, head of global macro strategy. Thank you so much for being with us. And some really interesting calls there. I was struck by his answer to your question, Romaine, saying we can no longer bet on curve steepening and that the dollar should continue to strengthen, as Taylor was pointing out. A really deeply out of consensus call here. The idea, Romaine, of the dollar continuing to strengthen could potentially offset some of these Europe and emerging market bets that have become increasingly dominant in people's portfolios.
Absolutely, and I think the jobs for a lot of fund managers just got a little bit harder here looking forward here, whether you're betting on a reflation or an unwind of that reflation trade. It's really anyone's guess here. I do want to point out here, too, that in addition to the drop that we saw in equities and, of course, that rise in yields, we saw a pretty massive drop here in spot gold prices and further weakening in that commodity space, something to keep an eye on as we get further into the day.
Yeah, and to be clear, Taylor, you've been noticing this, too. We've seen a retracement from some of the immediate knee-jerk moves. Nonetheless, people still responding to Jim Bullard.
I hate to tell you, Lisa, we're back to being unch on the day.
Oh, gosh.
Tom Keene is rolling.
A standard deviation of the English language. We have that right here. Coming up on the Open, Nisha Patel of Parametric Associates coming and joining us on Bloomberg The Open. And going into the end of the day, the close with Romaine and Taylor. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Italy has introduced a 5-day quarantine and mandatory testing for travellers coming to the country from the UK. That's according to a Facebook post from the country's health minister. Current measures banning arrivals from India, Bangladesh and Sri Lanka have been extended, while travellers holding a so-called green pass from the European Union, US, Canada or Japan will be allowed to enter the country. Now, Iranians are voting today in a presidential election that's expected to see a hardline conservative replace a more moderate Hassan Rouhani. That could complicate efforts to restore a landmark nuclear accord that has major implications for Middle East security and oil markets. The narrow field is expected to depress turnout to a record low and all but ensure the election of a 60-year-old Ibrahim Raisi. And Elon Musk's startup is working on much wider tunnels than publicly announced. Bloomberg has learned the tunnels that the boring company is pitching to potential clients are 21 feet in diameter, much wider than the 12-feet tunnel the company has built to date. The larger tunnels would be for expansion for boring, which has been working on systems for passenger transportation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered
powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
We have 70,000+ people, and we're concentrating on getting them back to work because that allows people to move about under the CDC guidelines without masks and things like that. As more people get vaccinated, we keep bringing more back. We've got a lot of work to get those back. But the view is after Labor Day, our view is all the vaccinated teammates will be back and will be able to operate fairly normally, and we'll then start to make provisions for the other teammates as we move through the fall.
Brian Moynihan there, of course, Bank of America CEO, talking about, of course, the return to office here right now. Of course, we have to talk about, I guess, what is the return to the market, or at least the return to the general belief here that the Fed may move faster than expected. We're below 4,200 on S&P futures. We're above 150 on your 10-year yield. Gold, which at one point was up about 1% here, now basically unchanged on the day, seeing a lot of softness in the commodities space. The VIX elevated as well. Romaine Bostic here alongside Taylor Riggs. Tom Keene out today.
You did better than Lisa. Yeah. She called me Riley the last hour.
All right. Well, you're Taylor to me. Of course, Taylor Riggs is in for Tom Keene. Tom Keene, of course, had, I believe, one too many martinis. So he should be back, hopefully, and recovered on Monday. Lisa is off to this other show, which means the full Bloomberg Markets, the closed takeover of Bloomberg surveillance is in effect, at least here, I guess, for the next 10 minutes.
I love it. And what that means is we are on the day. Romaine, as you talk about some of the comments we've gotten from the Federal Reserve, you pull those into some of the market reaction that you discussed, sort of unchanged now on yields after we had been higher after some of those initial Bullard comments. And then, of course, we talk about, Romaine, where we are, economics, vaccination rates, this reopening. What does that mean for economic growth? And then, of course, travel opportunities. There is no better person to discuss travel than Brian Kelly. Of course, we know him as the points guy. I'm a huge fan on Instagram, following you. And of course, some of the big headlines this morning that the EU sort of fully trying to reopen to U.S. visitors. But I guess the big question is, can I still afford a flight, or are my flights now priced out of my price range to Europe?
You know what, Taylor? The best deals this summer are to Europe. We're seeing $1,000 one-way business class fares to Europe, and it's also a great time to use those frequent flyer miles. So many of us have them. We're hoarding them because we haven't traveled that much. So use them now, especially because you can cancel your frequent flyer mile tickets and get them all back and all your taxes and fees back, which is much better than getting a voucher if you pay for a ticket.
Interesting. I mean, you mentioned business class there. Where are we in terms of the return of the business customer? We have heard that those are the big ticket items, but that is nowhere coming back from the corporate side. Is this all leisure still at this moment?
It's mostly leisure travel, although every major CEO of an airline that I've talked to says that business travel is coming back much quicker than they anticipated. As we know, the big banks are going to be calling people back to the office, usually after Labor Day. And business travel is going to come back in a different form. I know at my company, we're not going to be doing senseless meetings that we could do over Zoom, but we're going to have longer, more impactful team building meetings at resorts. So I think it's going to come back a lot quicker than we thought, but it's going to look different. That Monday to Thursday grind might change a little bit.
Yeah, you know, it's interesting you bring that up. I was actually speaking with the CEO of Marriott International yesterday, as well as the CEO of Trip.com, and they talked about this idea of sort of, I guess, hybrid type travel, where you're going to see much more of a blend between that leisure and business customer here. How does that sort of change at all, I guess, the way that some of the airlines and the hotels sort of price their offerings and, I guess, sort of adjust their offerings to deal with those types of customers?
Yeah, you know, planes are full these days. They're still, upgrading people into first class. You know, the business class total fares are down. I think we're going to see a return to profitability or not stemming the losses this quarter for most of the airlines, but they're not those big ticket fares, the $10,000 business class fares to Shanghai, right?
Yeah.
So definitely the airlines are looking for more ways to raise revenue. A key way they did that during the pandemic was selling billions of dollars worth of frequent flyer miles to the credit card companies. And what we're seeing is huge offers for consumers in the credit card market. You know, we're looking at 100,000 mile offers to get a single credit card. think there's 7 different cards offering that. Yeah. So I think we're seeing a shift in the way they're accounting for the revenue, but making it up through co-brand partnerships is a key way to do that.
And do you think we'll get back to a stage anytime soon where we will see some of those offers dangled a little bit more out there? I mean, I hear a lot about cost issues with a lot of these companies. They're obviously having to pay a little bit more for workers here. And there's this idea here that in order to protect their margins, that means they can't offer the same type of discounts that they did in the past.
Absolutely. We're going to see more ancillary fees, even though the airlines did, get rid of change fees over the pandemic. We've already seen them start to roll that back, right? In May, most airlines now won't give you that free change if you book basic economy, which is what most leisure travelers are booking, that cheapest fare. We've also seen some bogus fees from hotels for service fees, cleaning fees. Certainly in the car rental space, we're seeing exorbitant rates and fees. So travel prices are creeping up. This summer is not the summer of $40 fares across the country like we saw a year ago. So, I think the airlines are very smart at coming up with ways to bring in that ancillary revenue.
Quickly here, Brian, where's the hot spot to go this summer?
I mean, we're still looking domestic. Key West, Miami, Hawaii is through the roof. So many people just want to travel. And even though Europe is opening, I'm excited to go next month. It's been really confusing to figure out what the rules are. EU rules versus individual country rules. Certain countries will release information on Facebook, and it's, luckily at the Points Guy, we break this all down for our readers, but to the average consumer, it's still way too confusing to go abroad. So, and we're seeing huge amounts of capacity added to the Caribbean for Q3, actually more than Q3 2019. So people are headed to the beach. We all need a break.
You and me both. The Points Guy, Brian Kelly, thank you so much for joining us. Romaine, what do we have to do to convince us to take what does Tom call it? The surveillance jet stream down to Key West.
I
think we need a Bloomberg Markets.
I took the Sikorsky in right now. It's right there on the roof right here over on Lexington Avenue.
We need a beach trip.
Yeah, we need something. We'll talk to Mike and see if he can set that up for us. But let's check in here on the market. It's going to be, we got a lot. I mean, believe it or not, you and I, we have to work for the rest of the day here together here, and we're going to have a lot to talk about here. You're looking at S&P futures right now, 4184, Taylor. And I think more importantly, when you talk about some of those comments that we got out of Bullard today and the idea we're going to get some more Fed commentary later today and through next week, you wonder what the reassessment is going to be, particularly when you look at a 10-year yield, 150 right now, a little bit higher than where we were just less than an hour ago.
Talk about the big move downward in yield on the 30-year yesterday at one point, right, down 16 basis points to a 205 or so, and starting to get a lift back up after those comments from Bullard that, of course, he was the 2022 dot. He, of course, is looking at a hotter housing market, some of the tapering of those mortgage-backed securities, saying that the taper discussion is officially open. And then, of course, we get calmness now, unch on the 30-year, Romaine at a 209. But the equity markets are not unch.
Yeah, this has been fun, Taylor. I guess for all of our Bloomberg radio and TV listeners and watchers who are wondering who the heck we are, Romaine Bostick and Taylor Riggs, don't worry. Tom Keene will be back, as will Jonathan Ferro and Lisa Abramowicz. This is Bloomberg Surveillance, Taylor.
Oh, this is. But stay tuned because we have 2 new shows coming up. We have Balance of Power, Dr. Albert Bourla, who's the Pfizer chairman and the CEO. And then, of course, Bloomberg Markets The Close. Romaine?
I hear that show's really good. I love that show.
The best 2 to 3 anchors in television. This is Bloomberg.